Down by another 0.8%. Higher bond yields, higher dollar, all of that acting as tightening financial conditions, weighing on risk assets. This is the ongoing move at the long end of the curve. The US 30-year yield above 5% for the first time since 2007, as we said. Here's the German 30-year showing that wind that blows across the Atlantic and takes yields higher here in Europe as well, Tom.
European futures then looking ever uglier on the back of this rout in the bond markets. DAX futures pointing lower by 98 points. FTSE 100 futures pointing below that 7,500 level. A drop of 35 points is flagged. Over in France, you're looking at a drop potentially of about 0.5%, Anna.
OK, as we continue to take out round numbers then, as yields march higher on both sides of the Atlantic, let's see what this does to European equity markets, to risk assets here in Europe this morning. The FTSE 100 opening fairly flat for the moment, but the futures picture had suggested would be weaker across many of these markets. So we'll keep our eyes open for that. The pound is on the back foot, the Swiss franc a little weaker, the euro down 0.1%. The dollar rises then on the back of those higher treasury yields. As we've been saying many times, the 30-year then taking out that 5% level for the first time since 2007, pushing the dollar a little bit higher. Here's the FTSE 100 deteriorating then this morning, down by 0.4%. The Italian FTSE mid down by 0.7%. Really all one big story, very nicely illustrated in the sovereign bond column. We've got those yields going higher. We're seeing that continued sell-off, up by 7.8 basis points on the US 30-year just this morning at 5% on the nose. And you can see that having an impact at the 30-year and the 10-year horizon across European bond markets. So what happens in the US, certainly not staying in the US, then, Tom, spreading across the Atlantic.
And on the US, the technology story, of course, the run-up that we've seen year to date that stalled around mid-July, that has, of course, now faced the headwinds of these higher yields. They've been able to push through these big tech names in the early part of the year. Higher yields and higher rates, not now. And look at the technology sector here in Europe, down a full 1 percentage point. The biggest losses, some of the biggest losses coming through for that sector so far in the first few minutes of this open. Currently down a little over 1%. Basic resources also down by 0.7%. One sector that remains just clinging onto the green, utilities, after the heavy losses for that sector yesterday, more than 2% downside for utilities yesterday, along with real estate, some of the biggest losers of the session yesterday. But today, utilities is just adding gains of about 0.1%. Maybe a bit of a safe haven play coming through for utilities. Travel and leisure is also sensitive, of course, to the higher rates environment. That sector currently down 0.9%. Losses also coming through for autos. 0.8% is the drop there, and financial services in similar territory. So almost every major sector in the red. Utilities just clinging on to gains of about 0.1% across the benchmark. Losses of 0.4%, Anna.
OK, so the high yield environment taking its toll across stocks. Let's get to Sophia Halter-Acosta from the Markets Today blog. They're, of course, focused on the sort of UK expression of all of this, but also the global stories. Sophia, good morning once again. Let's start with one asset that really was caught up in all the excitement, if that's the right word, around the JOLTS number coming out of the US yesterday, the way that sent yields higher. We're still dealing with that to some degree this morning. And that was the Japanese yen. Really incredible moves in the yen. It seems smacked down by something. Whether that was intervention, we can't be entirely sure because the government won't comment. But give us your thoughts on the yen this morning.
So, as someone who doesn't actually typically follow the yen, I saw that move on my screen, and I just commented, "Wow, you know, this is a big move." So, after kind of weakening very gradually against the dollar, we saw that kind of very quick move lower after the jobs data, and then that spike, which really, Anna, I mean, if it's not intervention, then what is it? Someone made a mistake. We will see. We typically get maybe a confirmation of intervention in a few weeks, but Japan not not commenting so far. What's happened? So the last time that the BOJ intervened was in October. They intervened at the 150 handle. That's where we were again yesterday, because the market was kind of so jolted. Can we say jolted? Are we using that pun a bit too much? By the jobs data. And since then, US yields have really ticked up higher. So there's so much pressure on the market. Can the BOJ continue to fight this, though? That was the question that most people were asking yesterday. Does it have enough power to fight the market? I think there are a few questions around that. There is also a little bit of warning around intervention at 150. So if the market does push it again there, you could get burnt by more intervention. It's a very interesting currency. I think those spikes are just incredible.
Yeah, the 2% move briefly yesterday in the yen. Strategic ambiguity maybe for the Bank of Japan. Currently you're looking at 149.14 on the Japanese yen, just currently down about 0.1%. When it comes to these equity markets then, the linkages between the sell-off in the bond markets and the pressure that we're seeing across stocks, Sophia, how are you thinking about what the future holds? Are we looking to earnings? What is or is it the non-farm payrolls on Friday? What is kind of the next catalyst? Is there anything that can put a floor under these stock markets at this point?
So I think that's an excellent question. And why are equity markets so kind of concerned about these higher yields? Far more concerned about this than they were about inflation. The inflation remaining sticky and the kind of higher for longer narrative. And I think this ING note that just landed in my inbox explains it really well. This is because inflation can be from the corporate side of things, can be passed on to customers by increasing prices, but real rates is a tax on the borrower. So look at the credit market for cracks. This is why the stock market is concerned, because it does impact companies, their ability to borrow. It means they will have to pay more to borrow. And look at this heading into earnings season, where will be the first domino to fall if we do get refinancing problems. And that's why the equity market is so concerned, Tom.
Okay, so watching those refinancing pressures potentially for some of those corporates as we walk in and lead in, of course, to the earnings season. Sophia Horta-Acosta from our Markets Today blog, thank you very much indeed on the yen and the outlook for equities. You can get more, of course, from the team on the front page of the Bloomberg UK website or by typing T Live Go on the terminal. Let's get to US politics then, and this ties in to the Treasury conversation as Anna flagged. Kevin McCarthy has become the first US House Speaker in history, to be booted from the job. He was toppled by dissidents within his own party, plunging Congress into an internal power struggle as it faces key deadlines on avoiding a government shutdown.
I believe I can continue to fight, maybe in a different manner. I will not run for Speaker again. I'll have the conference pick somebody else.
Okay, for the context for the analysis now, let's bring in our Brussels Bureau Chief, Kevin Whitelaw, who covered the White House and the Senate for many years, has deep experience on the politics of the US. Kevin, thanks for joining us. Your assessment of where things stand then as we lead up potentially to another cliff edge around another possible shutdown in the US.
Well, that's right. The Congress gave themselves 45 days to try to fund the government, but obviously now they're going to just be trying to figure out how to run themselves. I mean, this is really a sign of just how razor-thin the majority is for the Republicans in the House. They only have a handful of seats that they control Congress by, and so it only takes about 5 or 6 Republicans to oust the Speaker. That's what happened. No Democrats came to Kevin McCarthy's rescue. And so now we're basically in a situation where it's kind of an open power struggle. There's no obvious successor. Kevin McCarthy said he's not going to run again. And the temporary Speaker, Patrick McHenry, is essentially just next in line in a succession, but it's a temporary succession. And so there's going to have to be a series of elections. It took a very long time to elect the last one. And it's really unclear how long it's going to take to find someone to permanently fill in for Kevin McCarthy.
Yeah, Kevin, good morning to you. So it's going to take some time. Does all of this mean that a shutdown on or around the 17th of November is now much more likely?
I mean, I would say it's more likely. Obviously, Patrick McHenry as the Speaker can try to, marshal things through, but the House Republicans are going to be super distracted by this. There could be rounds and rounds of votes. It took McCarthy a very long time to win his speakership, and he had to promise the party that he changed the rules to allow a single member to bring up a vote to oust the Speaker, and that's what happened. So sort of the price of admission was also the price of his undoing.
Thanks very much. Thanks for joining us, Kevin. Good to get the update. Bloomberg's Kevin Whitelaw joining us there with an update on US politics. Coming up on the programme, cash is no longer trash. That is according to Ray Dalio, the Bridgewater Associates founder, who shifts his view on cash as an asset class. More on that next. We'll talk about credit markets. We'll talk about the impact of 30-year yields at 5%, just dipping below that now, but 4.98, not far from it. But we've been over 5% this morning. We'll talk about the impact of that on asset allocation. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Markets Today. We are a little over 11 minutes into the European trading day. You're seeing further losses across European equity markets, about 0.4%, and bond markets as well, with yields jumping higher as we readjust to the higher for longer environment around rates. Just flagging one corporate story, Sandoz opening at 24 Swiss francs in its trading debut after being spun off from Novartis, the generics drugs maker. And we're going to be speaking to the CEO, Richard Saynor, in the next few minutes. But that stock opening on its debut at 24 Swiss francs. Let's get a check on some of the other individual stocks on the move with Joe Easton. Joe, what is standing out to you?
So Tesco clearly outperforming despite these declining markets. Tom, the company beating expectations on full-year profit, and also like-for-like sales up around 8% in the latest quarter, and that is also boosting Sainsbury's as well. Another smaller retailer in the UK, the tiling company Topps Tiles, not seeing a price, but they did say that their earnings are holding up. Investors not exactly floored by that one at the moment. The one that's really dropping is Spirit Communications. This is a UK company that says landline issues in terms of some of its broadband has caused a profit warning today, and that one is down more than 30%, now 37%, as we can see on the screen here. In terms of those pharmaceutical stocks, as you mentioned, all the focus today will be on that spin-off of Sandoz. You just mentioned the price. We're seeing Novartis coming down, but bear in mind that that is potentially a technical move, given it will have that spin-off readjustment. In terms of SAS, one analyst said pre-market that stock would go close to zero at the open, and he wasn't wrong. That one down 87% as they announced a restructuring package, which Air France is taking a slice of. They're investing around $145 million for a 20% stake. Both of those stocks coming down, but as I say, 87% is the move lower for SAS. The worst performer in the Stock 600 is Nexi. Now, this is as Citi cites a slowdown in payment processing. This company competes with PayPal, Adyen, companies like that. Citi is negative on that one over in Italy. That one down 2.3%. And then a couple of other broker moves to bring up ASOS we had in the stocks to watch. Now, ASOS gets a buy rating over at UBS. Big declines for that one this year, given the cost of living crisis. The Gucci owner, Kering, downgraded at Bernstein. Now, they were outperformed for a long time, but go neutral on that one, given the luxury goods environment at the moment. In insurance, we have Aviva. This one upgraded at Jefferies, their preferred life insurance stock, according to the broker there. And then Relics is recommended you buy that one by Goldman Sachs, the UK business communications company, rising on the FTSE 100.
Joe, thanks very much. Joe Easton from our equities team with a briefing on some of those stocks on the move this morning. Now, the Bridgewater Associates founder Ray Dalio has ditched his cash is trash stance. Speaking at the Greenwich Economic Forum, Dalio talked up cash as a valuable asset in the current market.
Cash now has a relatively attractive appeal. Now, when you look at the expected returns for this moment, cash is a relatively attractive asset class at this moment.
Ray Dalio there. Joining us now, Alexandra Ivanova, fund manager at Invesco. Alexandra, nice to speak to you this morning. We'll broaden our conversation to think about all the moves we're seeing in bond markets, credit markets, what your strategy is from here. But just focus on this question of cash. I think being a fan of cash is a view that you have sympathy with. What is your strategy around cash and cash equivalents at this point?
Well, I mean, Ray is correct. The cash now pays you, and it has some expected return without the price risk in it. So, in terms of portfolio allocation, we have been increasing the liquidity in our portfolios just because it makes much more sense. Even if you are focusing on income, there is a lot of income to be had. Cash, in terms of exposure to the front end of the yield curve as well in the US, T-bills, they look very attractive from an asset allocation perspective.
Alexandra, we're just going to get your views on where you think this bond route is going. But before I get there, I just want to bring some data to the attention of you and our viewers around Spain and composite PMI and services PMI, and the prints for the month of September for Spain. Services PMI coming in above the survey, 50.5, so back in expansionary territory compared to the previous month of 49.3. So services PMI for Spain back in expansionary territory. Composite also back in expansionary territory and coming in above the survey and the expectation, 50.1 for composite PMI and services PMI. We're going to get more PMI data out of the Eurozone, across Eurozone economies in the next hour or so. We'll bring those to you. Alexandra, just on your views around this bond route that we're seeing, what is your expectation of where things go from here? Is this bond route looking a little overdone at this point?
Well, for big asset allocators, it's all about treasury market at the moment, and I think you're right. It's driving all the global rates at the moment, and there are a couple of things I would point out. One thing that makes me nervous is the sell-off and the speed of it that could weigh on the market sentiment. But if you look at the historical patterns, we are actually following previous hiking cycles. When the Fed tends to increase the rates, we see the curve flattening and all the pain is felt in the front end of the curve. But once we get to the peak of the rates, and I think we are getting close to it, and maybe the Fed is done because market is doing some of the work for the Fed. and 10-year yields tend to reach peak rates and sometimes even overshoot. So we are somewhere in the vicinity. I don't know what the actual number is. Is it the 475? Is it 5? But intuitively, it feels like we are getting to the levels where it feels like it's a good value. And once we stabilize, I think that's what the risk markets are looking for. We need to stay in the range for a while.
Okay, yeah, we haven't done that recently, have we? We've been on the move a lot, but we'll see if we stay in a range today. What are your thoughts on credit markets right now? US investment grade spreads. We saw them widening a little bit yesterday. A lot of people have pointed out previously that credit markets had maybe been too immune to the rise in rates. Now we're starting to see some spread widening. What are your thoughts on investment grade?
So, credit in general has been quite resilient this year, and I think that has been surprising to most investors coming into this year. But I would say the fundamentals and technicals are quite strong, but the spreads have remained resilient so far, and there is a risk that they will be under pressure. So far, the rate sell-off has been quite muted until more recently. So the spreads tend to outperform in those markets, and your cash price stays stable. But if the sell-off in the rates market becomes much more volatile, that can weigh on spreads.
Yeah, so a bit of caution around the volatility in terms of the sell-off and what that could mean for spreads within credit as you look maybe to add investment grade. When it comes to the UK and sovereign debt here, Alexandra, is there any appetite for gilts? And do you have a firm view on the pound? Because of course higher rates and higher yields across gilts has not so far, at least in the recent months, supported the pound.
Well, the pound itself has other elements. So the risk element of it, that the UK economy is one of the, I would say, weakest links in the global developed market arena. So you need that risk premium, and rates alone would not necessarily be a way to track that. And as much as you would say that the US market is becoming a bit more geopolitically risky, when the risk market will turn, the dollar will still be attractive, and the reserve status of the dollar is still there, and that weighs on the pound itself. In terms of gilt itself, the front end again looks really attractive, and if you want to express a bit of duration extension views, I think having longer dated yields make a bit of sense. It's the hedging properties haven't come back yet. This year has been difficult for credit investors, but at some point, and looking into the future, I think we will get some reprieve from this sell-off.
Okay, Alexandra Ivanova, fund manager at Invesco. Thank you for joining us this Wednesday to walk through some of these key market topics and issues. We appreciate it. Coming up, we're going to look ahead to an OPEC Plus review of global crude markets. We'll discuss what can be expected from the group next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at BloombergLive.com/screentime.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
Let's pivot to the oil story, which is steady ahead of an OPEC Plus review of the global crude market. Ministers are convening online later today, but the group is not expected to recommend any change in policy. For more, let's bring in Bloomberg's Paul Wallace. So is this temporary drop then that we've seen over recent days in the oil price, Paul, is this the start of something bigger? Is he talking about $70 oil next year, for example?
Hi, Anna. That's a very big question in the oil market right now. Oil has been extremely volatile for a long time now. Right now, they are definitely the bearish concerns are back on the table, and those are high interest rates in most of the Western world. The Fed recently implying that it's going to be higher for longer. JP Morgan just came out with a note and said there's already some demand destruction with oil prices as they are now in the sort of $90 a barrel territory. So that's what's pushing down prices this week. Brent's down about 5%. It's macroeconomic concerns. But on the flip side, the market is still pretty tight when you look at physical supplies. Time spreads are still indicating a market that's short of oil barrels. So there's no inevitability that this drop won't be reversed soon, and that we could, within a fairly short space of time, be talking once again about $100 oil.
So, Paul, what can we expect then from that OPEC Plus review today, just briefly?
I think for all indications are that OPEC Plus is going to stay put, and that it's going to maintain its recommendations to members for the time being, and that means for at least another month. When it comes to the Saudis, and they're the ones implementing by far the biggest cuts within the group, they still seem set on holding where they are until the end of the year. They've got supply cuts of about 1.5 million barrels a day, and they don't seem willing to reverse those this year.
Okay, so no change expected. We'll keep an eye on it. Thanks so much. Bloomberg's Paul Wallace with the latest on the oil market. Coming up, the generic drugs leader Sandoz starts trading at 24 Swiss francs after its spin-off from Novartis. We'll speak to the CEO, Richard Saylor. That conversation next. This is Bloomberg.
middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Markets Today, 30 minutes into your European trading day. Let's get to your top stories. Stuck in a slump, European stocks dropped to the lowest level in more than 6 months amid a surge in global rates. Yields on 30-year bonds in the US and Germany hit the highest levels in over a decade. Sandoz starts trading. The Novartis spin-off opens at 24 Swiss francs. We will speak to the CEO about the future of the generic drugs business. Plus, fresh turmoil in Washington as Kevin McCarthy becomes the first ever US House Speaker to be removed from his post, increasing the odds of a US government shutdown. So, Tom, the higher yield environment still a talking point, beginning to sound like a broken record, I feel, this week, and maybe the last couple of weeks, in fact. Higher yields, stronger dollar, all of that, tightening financial conditions, stocks dropping. London, though, keeping its head up in the green.
Well, to your point, where are we in this sell-off? Really consequential on this yield squeeze for the bond markets and, of course, for the equity markets as well. In Europe, you're looking at losses of 0.3%. But it should be pointed out that in the session, you've paired some of the heavier losses, so we'll see how it unfolds throughout the rest of the day. Currently, though, you're off by 0.3% across the benchmark. The DAX is below 15,000, a drop of 110 points, down 0.7%. There's a hit coming through from the auto sector, which was one of the biggest losers across your sectors so far in the session. That is weighing on the DAX today. The FTSE 100 in focus for us as well. Flat for the FTSE 100. We look ahead, of course, to the OPEC Plus review in terms of expectations around oil prices, and then the politics of the UK with the Prime Minister Rishi Sunak giving a speech later today at the Conservative Party conference. Across your sectors then, let's flip the board and see how things are shaking out. The last time I checked, it was autos, it was technology that were taking some of the biggest losses in this high yield environment. There's the auto hit then, down 1.8% for that sector, and again, weighing on the DAX in the session so far. Yields, we know, high yields, bad news for the travel and leisure sector as well. That's been vulnerable to that change in emphasis in terms of higher for longer, and that sector is currently down 0.7%. High yields, typically better for margins of banks, but in this point in the cycle, the concerns around credit resilience, the concerns around balance sheet resilience maybe is a factor as you look to maybe higher loan losses coming through for banks. It hasn't come through yet, but we'll see how that picture is rounded out in the earnings season. Banks as a sector currently down a full percentage point. A bit of a safe haven tilt maybe to utilities or just pairing the losses of yesterday. That sector up 0.3% in the session so far. A couple of other sectors to bring to your attention then. Industrials down 0.7% and technology. There's the hit there from these high yields. Technology down 1.15%. And we've seen now that the big mega cap tech names over in the US are now showing their vulnerability to this higher rates environment. Let's bring you back to the benchmark then. Losses of 0.4% across the stock 600 at 438.89, Anna.
Okay, those are the moves then across sectors, and a bit of weakness then on European stocks this morning, down 0.4%. Let's go stateside, though, for another really interesting story. The blockbuster trial of the US versus Sam Bankman-Fried. It is underway almost a year after the collapse of the FTX crypto exchange that he co-founded. Bloomberg's Kayleigh Lyons filed this report from New York.
Sam Bankman-Fried's trial began in federal court here in Manhattan on Tuesday, where he is facing 7 charges related to fraud and money laundering. The trial proceedings began with jury selection. Multiple pools of jurors were evaluated for any bias so that they ultimately can decide his fate here. Sam Bankman-Fried was present in the courtroom on Tuesday. He had a shorter haircut. That signature mop of curly hair is gone. He was also wearing a suit that appeared too big for him. It seems that he may have lost some weight while in detention at the Metropolitan Detention Center. Of course, this case really centers around the implosion of FTX and Alameda Research, the crypto exchange and the separate hedge fund, both of which he had founded. And prosecutors say he orchestrated one of the greatest financial frauds in U.S. history, that he misused customer funds and used them for things like risky investments, real estate, and even political donations. Prosecutors will be aided by 3 key witnesses, all of whom were some of Sam Bankman-Fried's closest associates at the time this all went down. Gary Wang, the co-founder of FTX, Nishad Singh, who was FTX's head of engineering, and Caroline Ellison, his ex-girlfriend and former CEO of Alameda Research. All of them have pleaded guilty to charges and are cooperating with prosecutors. As for the defense, they will likely argue that Sam Bankman-Fried did not intentionally commit fraud. This is something that Bankman-Fried himself has said repeatedly in the lead up to this trial. And of course, he has pleaded not guilty to all 7 of these charges. This trial, though, is going to take some time to play out. It could last up to 6 weeks. And if he is indeed convicted of these 7 charges at the end of it, some of them carry large maximum sentences of 20 years for 5 of these counts. So it is very possible, if he is found guilty, that Sam Bankman-Fried could spend the rest of his life in prison, or be sentenced to it at least. Kayleigh Lyons at the federal courthouse in Manhattan for Bloomberg News.
Kayleigh Lyons there. Let's get back to European corporate news. The generics drugs company Sandoz has opened at 24 Swiss francs in its trading debut following its spin-off from Novartis. The Swiss drug maker moved to spin off Sandoz to focus on innovative medicines. Sandoz will now have more freedom, it says, to pursue its own growth strategy to challenge rivals in the generics industry. Let's talk about all of that and the future of the Sandoz business. The CEO, Richard Saynor, joins us now to mark the listing and to talk about the future of the business. Richard, nice to have you with us. It's a bit of a tough day for global markets, tough day for risk appetite and sentiment. I wonder how happy you are with how things have gone so far in terms of this listing.
Absolutely delighted. Clearly, it's a really important day for Sandoz to return back to the Swiss Stock Exchange and really now focused on moving the business forward, treating more patients and growing our business.
Richard, Morgan Stanley putting out a note this morning saying Sandoz could offer above industry sales growth and margin expansion, but proof of execution may be required. How would you convince investors that that execution is going to come through? What is your priority then for driving that growth and that sales momentum?
Thank you. I mean, look, let's be clear. For the last 7 quarters, we've delivered strong mid-single-digit growth, and that's our forward guidance. Clearly, my priorities over the next couple of years, maintaining that momentum in the business, executing an unrivaled biosimilar pipeline that we intend to launch both in Europe but also in North America, expanding the margin and then driving up the free cash within the business. But clearly, I think we're building credibility, really delighted with the filings and approvals that we've got. As we stand here today, we have something like 25 biosimilars, 5 we intend to launch over the next couple of years, addressing about a $50 billion market opportunity.
You talk about pushing up margins there, Richard. So what's the balance of generics versus biosimilars going to look like at Sandoz?
So we've guided over the next 5 years, we anticipate to launch about $3 billion worth of new products. Approximately half of that will come from biosimilars, and half of the absolute growth we expect to come from our US business. And it's worth noting that that $3 billion actually is twice the amount of product that we launched in the previous 5 years. So we're extremely confident that we're in a really great position to leverage that and build growth across the portfolio.
Richard, you highlight the growth opportunity in the US. What are the barriers to growth in the US versus in Europe?
They're both very different markets. First of all, it's perhaps important to reflect that pretty much, clearly more than half our business today is in Europe, and clearly Europe isn't one country. For us, it's nearly 40 markets. So we very much think about our development pipeline, really thinking about how we leverage the scale that we've already built in Europe. That means we've sunk most of the investment cost on a business that we know we can get that return. And that turns the US very much into an opportunity. A lot of our competitors, really, they have to win and execute in the US. For us, given our strength and depth of our business across the world, really the US becomes a very different kind of area. What's exciting, though, is clearly, as I said, we're now in the process of potentially launching 5 biosimilars into a US market. Even the US market alone is worth about $30 billion plus. The first of which was adalimumab, which we launched on the 1st of July, but clearly a strong progression over the next few quarters.
How important do you think it is for Europe? You talked a bit about the opportunities in the United States, Richard, but as a European listed business, how important do you think it is that Europe has a listed generics business, just like we see in the US, in Israel, in India?
Absolutely. And what's really unique about our business in Europe is our scale. Many people think generics is about being cheap and first to market. And if that was the case, then you'd see very strong presences from some of the Asian players. The reality is they have a very small market share. Sandoz has really been able to build a significant presence across many markets, having real market intimacy, and then driving the portfolios we bring forward. So I think clearly having a strong European champion is very important. But also, let's step back. Ultimately, our mission is to provide healthcare for patients. We treat something like, or the generics industry provides something like 80% of all the drugs used in Europe. Without us, quite frankly, healthcare systems wouldn't exist. And so I'm really excited about the $400 billion of product that's due to come off patent in the next 10 years. And really, as the blue chip leader in this sector, really, I think we're extremely well positioned to capitalize and capture a significant proportion of that value.
Yeah, and obviously to get those drugs to market and to get them to customers and patients, you need well-oiled supply chains, Richard. What is your current assessment of supply chain pressures? Are we back to kind of pre-COVID normals? And in terms of input costs as well, the inflationary impact. It's more challenging, of course, to pass on costs when you're selling generics because of some price caps. What is your current assessment of supply chains and inflation inputs?
A couple of questions there. I mean, clearly, we have a very large supply chain, but I think since post-COVID, we've been in a much better position to work with governments and payers to help them recognize the benefit that we provide. Sandoz is pretty much the only remaining antibiotics manufacturer left in the Western world. That gives us a unique opportunity to talk to governments and help them understand how we can build much more sustainable supply chains. A couple of examples, the Austrian government have co-invested with us in Austria in terms of helping reduce our manufacturing costs. Different governments are finding mechanisms to reward us to build more inventory and find different ways to shape tenders to support European-based suppliers. So I'm very confident. And what we've been able to see is really able to pass on some of the inflationary impacts that you've seen. Normally, our industry would expect to see about 5 points of price erosion year on year. We've seen nothing like that this year. We've been able to pass on modest price increases through the system as we've seen some of the input prices going through. So I think that puts us in a really strong position as we close out the year and building momentum into 24 and beyond.
Okay, Richard Saynor, CEO of Sandoz, joining us from the Swiss Stock Exchange on the listing of that business, the spin-off, the 100% spin-off from Novartis, 24.19 Swiss francs currently on that stock. Really appreciate your time. Thank you. Coming up, it's UK Prime Minister Rishi Sunak's big day and big speech at his party conference later today. Is he already, though, facing a backlash over the possibility he may curtail that high-speed rail investment? We discuss that next. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Welcome back to Bloomberg Markets Today. We are 44 minutes into our European trading session. European equity markets just losing a little bit of ground this morning, down by 0.4% on the Xetra DAX. Elsewhere, losses not quite so bad. The FTSE 100 trying to keep its head above water, and actually some sectors in positive territory, 6 or 7 of them led by utilities, personal consumer goods, grocery stores. Tesco not doing too badly this morning. Autos and auto parts and technology, some of the worst performing sectors today. Getting some breaking news, though, coming through from Italy in the shape of the PMI numbers, and we're just getting the latest look at the PMI data here. Interesting to see the Italian composite PMI then coming in at 49.2. That's better than was expected at 48.7, but it is still below 50, still in contraction territory. That is a similar story to what we heard from Spain, where things had at least improved, and in Spain improved to a degree that they went actually into expansionary territory. So interesting to watch this picture of PMIs building up as we go through the morning then, Tom.
Yeah, Eurodollar 104.81. Not a lot of movement on the back of the Italian PMI, but up by about 0.1% for the single currency so far in the session. Now to the UK, and the Prime Minister, Rishi Sunak, is taking centre stage at the Conservative Party conference today for what is shaping up to be perhaps the biggest speech of his political career. Joining us now then is Bloomberg's UK correspondent Lizzie Burden, who's been on the ground for us at the Conservative Party conference from the get-go. Lizzie, what do we expect then from Sunak's speech?
Well, look, Tom, I've been thinking a lot about the song that he's going to pick to walk into. It means a lot to Prime Ministers. And we know that he's a Taylor Swift fan, so maybe it's going to be Look What You Made Me Do, in reference to the pressure on him to announce that he's potentially scrapping the northern leg of HS2. Maybe it's going to be Blank Space, in reference to the lack of policy ideas that we've had at this conference. But look, seriously, there is a lot of pressure on the Prime Minister in this speech, as you say, both to unite his party, but also to inject some inspiration into this conference hall. We know that the plan is to talk about how he's going to fundamentally change Britain. That could come in the form of increasing the legal age for smoking. But as I say, what's expected to dominate this speech is his announcement on HS2. It's been a commitment that has lasted through 5 of his immediate predecessors. It was an absolutely central part of this pledge to level up Britain under Boris Johnson in that 2019 manifesto, and before that as part of the Northern Powerhouse. You've had politicians from across the spectrum calling for it to be continued, including the Conservative West Midlands Mayor Andy Street, who is at the moment under fear that he'll resign over this issue. So massive pressure on that. But fundamentally, the trouble is the Conservatives have been in power for 13 years. So to present himself as the change candidate for the long term is a really hard sell for Rishi Sunak today. The polling, the latest polling in my inbox from Savanta, suggests that closing in the poll gap with Labour last week was actually just an anomaly, and things have gone back in the wrong direction for the Tories. But I wonder whether to try and make a change to that. This is the moment where Rishi Sunak shows a bit of his personality, the real Rishi Sunak, whether he hints at this story of his personal story of aspiration, because the Chancellor Jeremy Hunt in his speech had one line talking about that, so maybe we'll hear a bit more of it from the Prime Minister today.
Okay, interesting. We will certainly tune in for that. Lizzie, thank you very much. Bloomberg's UK correspondent Lizzie Burden with a preview of what to expect from Rishi Sunak and the latest from the Conservative Party conference in Manchester. Well, sticking with the controversy surrounding the fate of the northern leg of HS2, the high-speed rail project that is in question, at least between Birmingham and Manchester. As we've been hearing, the UK Prime Minister Rishi Sunak could cancel that northern leg of the line in his speech later today. This is the cost of the full project could reach £100 billion. Joining us now, Bloomberg's City Lab editor, Tim Coulter. Tim, very nice to have you with us, and it's good to have you and your City Lab expertise on the programme, because you write about cities and all things that affect cities, and this clearly transportation and infrastructure spend a big part of the conversation daily, I'm sure. So why did HS2 costs get so high, I suppose is the right question to be asking, when we're going to be likely hearing about part of the project being pulled?
Well, there's a number of factors involved. First of them is inflation, which we've all been seeing, in our daily lives. And when you start talking about billions of dollars and thousands of tons of concrete and asphalt and tracks and everything else, it gets very, very expensive very quickly. So that's a big part of it. A big question mark is how much digging was done to accommodate people in rural areas and keep tracks rolling, keep the trains rolling underground instead of keeping them on the landscape. And in our reporting, we found something really interesting, that in this initial leg, just from London to Birmingham, actually 80% of the tracks, more than 100 miles, is actually below ground. Something like 60-some miles are actually in actual tunnels, and then another 40-some-ish are what they call cuttings. These are just trenches that they dig to relieve gradients. So because you need a flat track to keep them running at the same thing. But one of these cuttings is 30 meters deep. Another one, they had to move 1.5 million tons of earth that could fill the Royal Albert Hall 10 times.
Is this environmental concerns that are being addressed by engineering it in this way, or is it the NIMBYism that we see in the UK that holds back some of these projects? What is the rationale for that? Does it make sense, and is it being re-looked at?
Well, it depends on who you ask, to be honest with you. There are many people who would say that a lot of this digging was done to accommodate the NIMBYs, people who don't want to see these tracks, don't want to see these trains crossing their neighborhoods, but there are other people who say that, this is just part of the engineering. We talked to a professor of engineering at one of the universities here in London, who said that if you look at one of the new bullet trains in Japan, something like 80% of that is actually going to be underground as well. Whereas when they built them in the 60s, they were only 15 or 16%. He was saying that it actually could be cheaper in some cases to be tunneling rather than building them at ground level.
Okay, that is a really interesting angle to add to the story, because we were hearing from Mace earlier on, one of the contractors in HS2, about the added cost of tunnelling. So interesting to watch how that develops. Thank you very much. Really good to get the sort of global perspective from City Lab. Bloomberg City Lab editor Tim Coulter. And we'll continue the UK conversation throughout the morning. Grant Shapps, UK Defence Secretary, joins us at 9:30 UK time from the Conservative Party conference. No doubt the conversation on Ukraine there, but obviously domestic matters also to the fore. Let me just mention the French September services PMI number coming in at 44.4. The prelim number was 43.9, so we're still in contraction, but a little better than we'd previously seen, in keeping with what the trend we've been seeing from other parts of Europe this morning. More on that next. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
This is Markets Today. We are 54, almost 55 minutes into European trading day. Let's talk about what's happening across these markets, then dive deeper with Eddie van der Walt from our MLive team. Eddie, what breaks in this environment of higher yields across the curve?
That is the big question, isn't it, Tom? We're seeing curves steepening. We're seeing the long end move in particular. We're seeing yields across the board moving higher. I think the sort of things that are at risk is gold prices, obviously, and we've already seen those come down because higher yields and a stronger dollar will obviously hurt, a non-yielding asset. At the same time, I think things like pension funds that are forced to hold long-end bonds, and maybe the ones where their liabilities and assets don't quite match at the moment. I think those are the ones that are at real risk here.
Okay, we'll watch that. Certainly a lot of people talking about pensions, people talking about credit markets, corporate credit, and where we see movement there. We'll keep an eye on all of those. And real estate, of course, with a sort of longer-term horizon. Just mentioning the PMIs this morning, Eddie, as we're getting those numbers coming through across various European geographies. The German number showing that services, just like we're seeing in other parts of Europe, the services number has come in higher than expected. Not much, but it takes it crucially back into expansion territory, which is nice for Germany. But we all know the difficulties around manufacturing.
Yeah, absolutely. And it's the second order effect here, right? We are seeing a little bit of an improvement across the board in the PMI numbers so far from Spain, from Germany. And while these numbers remain fairly weak, I think it just shows that perhaps there is a turning point. And certainly the world economy definitely needs manufacturing and the real economy to start picking up if we're going to weather this storm that potentially comes from higher yields.
Okay, the euro pushing a little bit higher this morning, just 0.1%, 104.81. Thanks to Eddie van der Welt from our Markets Live team. Remember, you can get up-to-date analysis and insight from Eddie and all of the Market Live team. MLive Go is the function to use on your Bloomberg terminal. So the euro pushes a little bit higher, providing a little bit of respite from that strong dollar theme. That has been driven by the higher yields in the United States, in particular at the long end. We continue to watch that as the 30-year yield now just back below 5% at 4.95. More on the markets coming up. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. The U.S. Treasury 30-year yield touches 5% for the first time since 2007, with the global bond sell-off spilling over into other markets. Testing 150 while the yen spikes, Japanese officials refuse to say whether they intervened to bring stability in the FX markets. Plus, a fresh turmoil in Washington as Kevin McCarthy becomes the first ever U.S. House Speaker to be removed from his post, increasing the odds of a U.S. government shutdown. So we have a busy day. It's certainly a busy markets day. So let's go through straight away what the European markets are telling us. A lot of focus, of course, on treasuries and what that means for the spread of this financial round. Now, the sell-off in U.S. treasuries extended a third straight day. There's more and more conviction growing that U.S. interest rates could rise further from the current 22-year highs. The 10-year treasury yield is also looking set to hit the 5% threshold. This is key, especially psychologically. Now, here in Europe, we're seeing tentative markets. We're also getting some euro area September services PMIs, and that's at 48.7, a touch above expectations, but also anything below 50 still means a contraction. Now, this is a picture across the board for some of the things that we're looking at in bond markets. It's very clear that investors are demanding ever higher compensation to hold some of this long-dated debt. This is after major central banks have made it clear that they were unlikely to ease policy anytime soon. Of course, some of these concerns of also increased treasury issuance because of swelling budget deficits could weigh on these longer securities for much longer, volatility spilling into equities and spreading to corporate notes. So for more on this bruising week for treasuries, Bloomberg's Valerie Teitel joins us. And Valerie, I guess the question is for how much longer?
Exactly, Francine. For how much longer will we see this bear steepening of the Treasury curve? This move in yields that's led by the long end has captured our attention for so much of the last few weeks. But I want to show you just how stretched this move is. This is the 30-year yield versus its 200-day moving average. We are now trading nearly a percentage point above the 100-day moving average, which just goes to show that this momentum has really surprised all of us. Just how quickly and jarringly these yields have risen in just the last few weeks alone, Francine.
So what can you tell us about Europe? I mean, Europe's also not being spared.
This bond market rattling is going global, that is for sure. Not only are we seeing this move in the long end of the Treasury yield, but we're also seeing German bonds make some statistics as well. We had the 10-year German bond cross the 3% handle for the first time since 2011 just this morning. And then it is also hitting Asia, Japan, JGBs rising above 80 basis points for the first time in over a decade. We also saw other parts of the JGB curve rattled as well, the 5-year yield and the 30-year yield. But I want to talk a little bit more about this German yield move as well. If we look at what's happened in the yield curve, there was a time in this morning's session where we actually saw an uninversion of the curve. We saw those 30-year yields trade above the 2-year yields very briefly. We have bounced from that, but it is notable that this steepening, this uninversion pressure has gone global, Francine, and it is hitting Europe as well.
Valerie, thank you so much. Valerie Teitel there with a roundup of what we're seeing across bond markets. Now, joining us now is Virginie Maisonneuve, Global Equity Chief Investment Officer at Allianz Global Investors. Virginie, first of all, thank you so much for joining us. With all of your years of experience, this seems like a pretty remarkable week when you look at fixed income and the sell-off in global markets. What will break, Virginie?
I think you have to step back and reflect a little bit. There's potentially two really important factors. One is the, I would say, market encompassing the higher for longer. And we've been in that camp for a while. So frankly, it's a little bit surprising that there's such a big reaction where we felt there was a lot of indication that that should be the case. The second one is really thinking about what's happened in the US yesterday. And if, in fact, higher rates potentially over the rest of the week reflect a risk off in light of this chaos that we see in Washington. And my next question would be, how does that impact the elections? Of course, a more volatile Washington, a more divided Washington probably plays in the hands of some of the candidates better than others. So I think we'll have to divide that. The next question is, what is the impact of the steepening of the curves onto recession odds and inflation? And of course, the main criteria is how long will we see those rates stay high? So I think those are the key questions to make sure that we're positioned properly in the equity portfolios.
So, Virginie, again, we've seen quite a lot of volatility, and I want to ask you whether you worry about, for example, Treasury issuance to fund some of these swelling deficits and what that means in terms of volatility, also for your world, so corporate notes and equities.
Yeah, so really interesting. We've done a lot of work on debt inequities. And what we found is that actually large cap generally as fixed, if you look at Europe and the US, as fixed, 75% of non-financial corporate debt is fixed. So actually many of the large cap companies benefit from higher rates. That's, of course, very different if you look at the smaller cap stage or ecosystem, or companies who have business models that are not as strong. So for us, it's really about whatever the style that you're in, quant, growth, value, income, you want to be in the quality space of those styles, because until we go through that storm, and we'll get through that storm, you want to have a lot of diversification as well as a lot of quality in the portfolio.
But Virginie, could we actually see a correction in equities just because of this financial rout, if it doesn't stop in the next couple of days?
I think we could have, and this would be, normal, what I would call, volatility expected in Q4. I think if you believe that those that next rate increase or that steepening is not only due to inflation, sticky, or resilience, so good news is bad news if you want in the US, but also to a risk-off factor, then you should use that volatility to add and position portfolios if you don't have what you need in your portfolios. But I think it's fair to say that there's going to be a volatile environment until we have more clarity.
How much, and again, you laid this out, that we could see because of tightening in financial market conditions, we could have some logical negative consequences. But could it actually impact some of the larger caps that have so far been okay in refunding? I don't know whether, Virginie, at this point we need to also look at worst case scenario or whether that's premature.
Yeah, I think it's premature. I think you go back to bottom-up case by case, right? So you've had, for example, a D-rating versus the general market of tech by about 20%. Well, actually, some of the fundamentals for tech have improved. Again, it depends on your time horizon. If you have a long-term time horizon, which investors should have, you should look through those and find those stocks that have very strong structural backing. That's number one. For growth, right? And that quality balance sheet. The other thing is look for areas that are really oversold. And again, if you look at China, for example, that's the consensus, negative. Well, actually, the PMI numbers that came out yesterday were, in my view, quite encouraging and certainly in the line of what we're expecting in terms of the transformation of this economy. Yes, real estate and property is still an issue, but if you look at the strength of the new sectors, digital economy, green economy, and the PMIs for that was actually quite strong. And so we have that transformation taking place.
Is there a danger, and again, Virginie, we're kind of putting everything together because everything seems linked. We also have, the ousting of the House Speaker in the U.S. This is the first time it's happened. I don't know whether that will translate into foreign policy, possibly as a harder line to China, and so that also changes supply chain.
Yeah, this is important, of course. So I think the first, we know what the dilemma now, the contentious point was, which was Ukraine, the U.S. borders. Clearly, depending on who wins the next U.S. election, the posturing or the attitude towards China could be quite dramatically different. In any case, we know China phase 3, remember we've talked about this, China geopolitical stage, geopolitical power has changed, has evolved. Digital Darwinism, competition for the top spots through technology, that is going on. So whomever comes in Washington, those themes will remain.
Virginie, thank you so much as always. Virginie Maisonneuve, Global Equity Chief Investment Officer at Allianz Global Investors, stays with us, and we'll talk about sector-specific issues. Now, Kevin McCarthy, as we were just hearing, has been toppled as U.S. House Speaker by dissidents within his own party. It ends his tumultuous 9 months in the job and sending a fractious Congress into further disarray. Well, joining us now is Bloomberg's Derek Walbank. Derek, this feels huge, but it's also unclear what happens next, apart from concerns about a government shutdown.
Yeah, Francine, I think that's a really great tie-in to make there, right? The proximate thing that ended Kevin McCarthy's time as Speaker of the U.S. House of Representatives after just a couple months was a stopgap spending bill for a month and a half at spending levels that had already been negotiated. Now, if that sounds like a very little deal, that's because it is. It is not a remarkable piece of legislation, but McCarthy going forward on it over the objections of some on his right flank was the proximate thing that caused a motion to vacate, which it should be recalled, McCarthy had given these folks on the restive right an easier way to try and topple him as a sort of carrot to put him in the first place. This was the method by which he was taken out. Now, it does put in a lot of questions here. Chief among them, the mid-November deadline that you referred to, which I think is exactly the way to think about this. I think the base case scenario that a lot of people had made walking into the shutdown showdown weekend last weekend was that they thought that there was going to be a shutdown of some margin. McCarthy changed that dynamic because he said, actually, we're going to pull out from this. We're going to go forward and sort of save the day. Well, he's lost his job now. So what does that do to your base case? The second thing I want to make a point about real quick, and Virginie was mentioning this about Ukraine. If there was some language about what was going to happen with Ukraine funding, Kevin McCarthy's not there. Whatever deal you cut with him, the guy you cut a deal with doesn't exist anymore in terms of the person who can bring bills forward.
Derek, thank you so much. Derek Walbank there, of course, on the ousting of the House Speaker. We'll have plenty more throughout the day on U.S. politics and what that means for the ramifications going forward. Coming up, the Fed's Raphael Bostic backs holding interest rates high for a long time, so we'll discuss that next. And this is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
I'm very optimistic about the U.S. economic outlook. Short-term, inflation is coming down in the context of an extremely strong labor market. We're now engaging in a very substantial program of investments to strengthen our economy.
Well, that was the Treasury Secretary, Janet Yellen, giving her thoughts on the U.S. economic outlook. Now, the Treasury Secretary also cast doubt over whether a resilient economy would force rates to stay elevated for a long period, saying it's by no means a given. That's in contrast to the Atlanta Fed President, Raphael Bostic, who says the U.S. should hold rates for, in his words, a long time to bring down inflation. So let's bring back Virginie Maisonneuve, Global Equity Chief Investment Officer at Allianz Global Investors. Virginie, thank you so much for staying with us. I guess a long time or a very long time, it's unclear what that means. When do you think we'll see the first Fed cut?
Well, I think we have to see what oil prices do. And as you know, that supply constraints more, as well as this ongoing risk off that we're seeing. But assuming that you have continuing disinflation signs, I think that within, 4 to 5 months, we could be looking at rate discussions again. I think the supply, on the bond market that you mentioned earlier on is a very important factor as well. So the key for us is to understand how much that long bond increase in rate is going to impact the companies that we have, and make sure that we're positioned very carefully in quality stocks in the different styles that we have, as well as a bedrock of multi-factor, or if you want, very diversified portfolios, to be able to have ammunition to buy in that volatility that we will see over the next few months.
So, Virginie, how much of the third quarter earnings could be a catalyst for potential buying? And again, you lay it out, beautifully, very simply to understand the source of volatility and what that means, for example, being very careful to construct your portfolio.
Yeah, I think you'll see. So you could see, companies like the tech sector has derated quite a bit. You still have very strong underpinning in tech. And if you see when you have those earnings, some long-term plans and support for growth while the stocks come back on this risk aversion, those are names that you should look at, right? And this is the same across most of the sectors, I would say. Generally, when you have risk off, everything goes down, and this is when you have a very good fishing ground, but you have to do all the bottom work in a lot of detail.
So, Virginie, overall, are you adding to tech, for example? It's, valuations in certain parts of technology are falling. I don't know whether you still think it's too expensive.
So I think for us, it depends. You know, we have AI products, we have tech products, with cyber products, etc. Depending if you're a growth style, an income, or a value style, you know, each team and each portfolio manager clearly will do their own work. But I would say that, you know, in the growth space and clearly in our tech strategies, we will be looking to bottom fish, right, if the valuations comes to the right level.
Virginie, as always, thank you so much for all of your insights. Virginie Maisonneuve there from Allianz Global Investors. Now, coming up, Black and Blue, we discuss the drivers behind the bruising week for treasuries and global bonds next. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, you know, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Now, the global bond rout is deepening as the higher for longer narrative sinks in. 30-year Treasury yields have hit 5% for the first time since 2007. The pain has spread to equities. Now, for more on all of this, we're joined by Sofia Ortay-Costa from our Markets Today blog. So, Sofia, I mean, what a day, right, for markets. It's kind of bruised across the board without anything really happening. So it's almost like a sudden realization that this will be higher for longer. What's the end game? Like, what could break?
Yeah, exactly. I think the moves, it is kind of beginning of the quarter. Markets are clinging on to a new narrative. They were looking for a new narrative, and this seems to be the higher for longer one, even though, as you mentioned earlier on the show, Janet Yellen is saying this is not a given by no means. There's still a lot of factors at play here. But it's really, really spreading, starting on the long end, and that's essentially looking ahead to the long-term economic picture. where inflation will be persistent. You're getting that really priced in. Investors want to demand more for holding these longer dated bonds. And the fact is, whatever treasuries do, you'll see that move the gilt market, you'll see that move the euro, whatever's happening in the euro area as well. Really looking at the round numbers that we're hitting almost every single day. I am looking at the 30-year gilt market, Francine, because we're very, very close to surpassing those levels reached last year during the Truss era market crisis. But it's really, markets are panicking.
But I wonder, is this part, I mean, they're panicking, but it's unclear. Is this also because they worry about issuance? So we have these like ballooning deficits that they'll have to plug. And does it make sense for it to happen now, or could it have happened 2 weeks from now?
They are worried about issuance. There's also, I mean, if you just kind of zoom out, central banks are no longer buying bonds, right? They're selling. So you're seeing, at a time when actually the global bond market, global government bond market is enormous. You're seeing more issuance at a higher level. We did see actually 2 deals pulled yesterday. That was on the corporate side. But when you do have the demand-supply dynamics really kind of shift, and you don't have central banks as a buyer of last resort, that really puts things into perspective. I would say, Francine, if you're looking for the one thing to break, look at the credit market. ING has a really good note out this morning. Why are equity markets so concerned about this move higher in yields? It's because this is a tax on borrowers. So unlike inflation, which companies can kind of pass on to consumers through higher prices, they can't pass on the cost of higher borrowing. So this is really a key theme going into earnings season. Which companies will be under pressure from higher borrowing costs, and this is what's concerning equity markets, and that's why we're seeing all of that kind of ripple through the world.
And of course, this has huge implications. If you're a politician, you were just mentioning the 30-year gilts. I mean, we're here from Rishi Sunak a little bit later, and it could, if not make or break his election, certainly something else that he needs to deal with. And then watch out for maybe some of the more concerning periphery countries. I'm thinking of Italy and the spread between BTPs and, for example, German bonds.
Yeah, exactly, especially if these moves have kind of very little to do with what's actually happening on the ground in these economies. I mean, if we focus on the UK, actually Jeremy Hunt, the Chancellor, will today receive his first draft from the OBR of economic forecasts ahead of the budget and autumn statement. And we know that there's very, very little wiggle room over what he can do, and tax cuts are off the table. So it does kind of complicate policy because markets are so concerned, and really kind of anything can spook them right now.
Sophia, thank you so much. Sophia Orta-Acosta there from our Markets Today blog. Now, coming up, we'll speak to the UK Defence Secretary. This comes as the Prime Minister prepares for what could be one of the biggest speeches of his career today. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
Now, the U.S. Treasury 30-year yield touches 5% for the first time since 2007, with the global bond sell-off spilling over into other markets. Testing 150, the yen spikes. Japanese officials refuse to say whether they intervened to bring stability in the FX market. Plus, fresh turmoil in Washington as Kevin McCarthy becomes the first ever U.S. House Speaker to be removed from his post, increasing the odds of a U.S. government shutdown. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, here in the UK, the Prime Minister, Rishi Sunak, is also taking centre stage at the Conservative Party conference today for what is shaping up to be the biggest speech of his political career. Well, one of. Overshadowing the conference are questions over whether he will scrap part of the HS2 high-speed rail project, the UK's biggest infrastructure investment programme. Well, Mark Reynolds, the chief executive of contractor Mace, which is working on the project, says he hopes the government reconsiders.
This undermines massive amount of confidence in UK PLC. The fact that the government aren't willing to invest in actually what is the spine of a rail network of providing low carbon, high speed connectivity through the country.
Well, our UK correspondent Lizzie Byrne now joins us from, of course, the conference with a cabinet minister. Lizzie, over to you.
Thanks, Francine. Yes, I'm joined by the UK Defence Secretary, Grant Shapps, about to head off to a cabinet meeting. Thank you for making time for me. You're a former Transport Secretary as well as now Defence. We're expecting in the Prime Minister's speech later today an announcement on HS2. Why should investors believe in long-term decisions for a brighter future from the Conservatives when it appears that today a long-term plan is going to be scrapped because of short-term pressures?
Because of coronavirus, which is a very long term. I mean, last time we had a pandemic like that was over 100 years beforehand. I had hoped, as Transport Secretary in particular, that we would see a return to people to the railway, this railway in particular. I noticed checking the figures this week, we've only got 69% of passengers have come back. It's way down on where it was on this line before coronavirus, and I think eventually you have to look at a project that costs tens of billions of pounds, as the Prime Minister I know has been doing, and say, actually, is that the best way to spend tens of billions of pounds, or are there other things you could do? Just to clarify, though, I've seen quite a lot of commentary on this, there would still be high-speed trains pulling into Manchester. They'd be faster on the first section of the track, but even that second section of the track, over a period of time, receives upgrades, including things like digitising the signalling, which speeds up the journey as well. So the Prime Minister is prepared to take difficult, sometimes not immediately popular decisions, but in order to do the right thing, perhaps spend that money elsewhere and get to a brighter future.
Well, the Tory West Midlands Mayor Andy Street says that if that second leg of HS2 is scrapped, it's really going to scar the UK's international reputation among investors. Has the government had talks with Andy Street, given that there are fears he could resign?
So, first of all, the idea that the world changes, coronavirus, people don't travel anymore. My son's 19. He was offered a job and took it last year, but it's 2 or 3 days a week in the office. That's what's happening. you carry on and you pretend the world hasn't changed and carry on spending the money in that way isn't necessarily the wisest thing to do. And I think this is the thing about Rishi Sunak. He's prepared to look at the detail, actually really put his head in it and study it properly, take decisions, sometimes not popular immediately, but actually potentially good for the country. What we've heard all week is, well, that could disappear, that second part of the high-speed bit of it. What we haven't heard is what the benefits might be, and I think that's why we're looking forward to the speech today.
The benefits, perhaps other things the money could be spent on.
There's always a counterfactual, that's right.
Well, the Bloomberg Levelling Up scorecard shows that since 2019, since Boris Johnson's election, the left-behind parts of Britain have fallen further behind London and the South East. Why should it be a choice in the North between, let's say, buses or East-West connections and high-speed rail?
Well, look, first of all, I haven't seen the detail of how your index has worked out. What I do know is that we spent, since 2010, £33 billion on northern transport connectivity, roads and rail. I also know that what was called the integrated rail plan, the bit of it that connects the north together, for example, being able to get from Liverpool to Manchester to Leeds. These are things that often are talked about and forgotten in favour of, don't worry, we can knock another 20 minutes off this bit of a journey travelling from London. And actually the north deserves better than that, and this is perhaps a better way of thinking through that plan.
You're also a former business secretary. When we've got the headroom, would you prioritise business tax cuts over workers' tax cuts?
Well, look, those questions are for the Chancellor, and he would do all the...
him as well.
And I'm sure he'll tell you come an autumn statement or a budget. But you run all the modelling to see what you think is going to be in the best long-term interests of the country, and that is something that again this government is determined to do. It's not always going to be popular. If you want the sort of popularist say anything, do anything, claim anything, you've got Sir Keir Starmer for that. He'll do all of that for you. We're prepared to take the difficult decisions.
All right, let's talk about the Conservatives. You're now Defence Secretary. I'm interested in the differences between you and your predecessor, Ben Wallace. Do you agree with his view that the UK shouldn't be Ukraine's Amazon for weapons?
Well, look, I was actually in Ukraine, in Kyiv, last Wednesday, having talks with President Zelensky. Actually, he asked me to send a very important message back to the British people, which is to say a huge thank you. Britain has lent into this more than anyone else, led the world with it. You asked differences between me and Ben Wallace. I'm very committed to Ukraine. I had a Ukrainian family of 3 and their dog live with us for a year, and I want to see a situation where Putin cannot benefit from his illegal invasion.
Well, has Britain run out of stockpiled equipment to send to Ukraine?
No, we haven't run out of equipment, but it is true, of course, that you have to replenish the equipment.
Are you willing to send new equipment?
Well, I'll say one of the great things that's actually happened, and I've been talking to industry about this, is that Britain's become the first country where a company, BAE in this case, will actually go to Ukraine and actually produce the replenishment in country, which is a very welcome development as well.
Yeah, does the $4 billion that you're giving to BAE Systems cover the costs only, or do you expect them to turn a profit?
So I think that's possibly from a different announcement on Sunday that I made about the AUKUS submarines, and that's BAE, Rolls-Royce, Babcock, primes as they're called, and it lays the contracts for the first stage of what will be the Royal Navy's biggest and most powerful submarines that the Royal Navy will have ever had.
Okay, just going back to Ukraine, the US House Speaker Kevin McCarthy has been ousted. It clouds the outlook for US aid to Ukraine. How concerned are you that Washington isn't going to be able to restore funding before the election?
I'd say this, and again I discussed this with President Zelensky last week. There have always been concerns in different directions right from day one of this war. In fact, on day one, most commentators thought on day 3 Putin would be in Kyiv and a puppet government would be installed. So yes, of course, you think about the future and what might and could and perhaps may happen. Actually, that's been the Ukraine story all the way through. We will work together, including next week when I'll go to meet other NATO leaders and other what are called contact group leaders. 50 countries working to support Ukraine, so we will continue with that effort.
And just finally, earlier this week you were lavishing praise on Saudi Arabia, but we understand that Mohammed bin Salman's cancelled or postponed his visit. Why is that? Can you give us more information?
Look, visits and timetables change all the time, and I think the point you're referring to is I was pointing out, I've been to Saudi Arabia this year. It's a country in amazing social and economic change, and that change perhaps hasn't been recognised fully in the West. much further to go. It's not. I'm not saying that for one moment this is a liberal, democratic state of the type that we would recognise. But I do think that when change happens, you do have to recognise that. I don't think there's anything at all in timing of visits. Diaries often don't quite work out, and other events take place. But we will make sure that we're working very closely with our friends throughout the Gulf, actually.
Well, we'll keep an eye on that visit when it happens. Thank you, UK Defence Secretary Grant Shapps. Back to you, Francine.
Lizzie, thank you so much. Our Bloomberg UK correspondent with Grant Shapps. We'll have plenty more, of course, from the Conservative Party conference throughout the day. Looking forward to that speech by the Prime Minister, Rishi Sunak. Coming up, the venture capital winter is now over. That's according to Michael Furtick. He's a tech entrepreneur, and he joins us next to chat VC plus the rise of AI. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
Some people may say that AI can be more dangerous than nuclear bomb. So there should be regulation, which I agree. However, don't use AI. It's like don't drive a car or don't use electricity.
Well, the SoftBank chief executive, Masayoshi Son, they're calling on businesses to adopt AI, but for the technology to be regulated. Now let's talk tech with an entrepreneur, Michael Furtick. He's the founder of Silicon Valley VC firm Heroic Ventures and is credited with pioneering the field of online reputation management. Michael, as always, so good to speak to you. I mean, you focus on software development, basically VCs, and where the money, the smart money, goes. What's VC looking like in Europe right now?
Great to see you. So, last year, I said that there was a big VC winter coming in May.
Yep.
And now I'm declaring that VC winter is over. VC winter has been replaced by VC spring just in time for the fall. It's been widely reported that something like 75 to 50% downdrafts have been seen in venture investment at every stage, early through late, globally, sort of geographic independent. But I now see the green shoots of what I think will be the next big wave. Not just AI, but big-time AI. Yeah. And I'm seeing new deals happen. I'm seeing not just major recaps and pain. I'm seeing a lot of new early-stage deals. And I think you'll be seeing in the next year or two in the public sphere, like on Bloomberg, reports about companies that were founded in 22, 23. I think this is going to end up being one of the big vintages.
So, Michael, so first of all, where's the money coming from? Is it being pulled from elsewhere and put into, early startup tech because we talk about AI as the next big thing?
Yeah, I think it's a great question. So it's an essential question. So right now, because the Fed is giving you basically risk-free 5%, all this money's been pulled from risk on asset classes like venture. So a lot of venture is not going to come back. But the core venture, the really good professional venture capitalists, are now seeing good entry points, good valuations, right? Not silly high valuations. They're getting board seats. There's governance, not the kids coming out of Stanford, 22-year-old, raising $40 million with no board to report to. So you're seeing real healthy stuff. And this is back to, I would say, the regular, normal venture cycle, which is healthy, better valuations. And we're not investing in companies that were never really venture to begin with, sort of people-based businesses that are, in fact, sort of look like venture. We want to dress them up as venture. The hot topic, of course, is AI. And I do believe there is I've only felt this 3 times in my career. I thought the internet, there was going to be a before and after. CRISPR, there was going to be a before and after. That's the gene editing stuff. And now AI, especially generative AI, there's a before and after. I think this is the next 10-year wave.
I mean, I feel like when you speak to regulators or people in charge of, for example, stock markets, they're saying, Europe still needs to catch up in becoming a mature market like in the U.S., where pension funds invest in VC, where they invest in tech companies. There has been things at the margin here in the UK that they're trying to do to get that kind of funding. Is it actually going to work?
Look, I cannot advise pension funds on how they should pay attention to their superannuation needs. It's not what I do. But I can say that for some long-term holders, an allocation to venture and private equity has been extremely lucrative. Yeah. I think there is a reallocation happening, and I'm seeing it in the United States with the LP base with whom I work, and internationally also in Asia. I can say that perhaps some of the direct investing in startups and in private companies may need to move back to venture funds and the people who think about this all the time. There may be some experts at the pension funds who do this as well, but I think that the venture investing is probably best left to the venture investors, is my guess.
But you moved to Paris. France and Emmanuel Macron has done a huge push to try and attract the right investors to make it a tech hub.
Yes.
Is Europe ever going to be a tech hub for anyone?
I am bullish on the UK for a lot of reasons. I'm bullish on Eastern Europe. I'm bullish on Israel, as you know, which may or may not be part of Europe, depending on the conversation. I have a hard time getting very bullish on France for tech. I'm bullish on France for other things. I believe that France is still suffering from dirigisme, the kind of the de Gaulleist idea where they choose national champions. France does have an early jump, surprisingly, and I think by luck and by accident, on AI. Probably about 10-20% of the best AI minds in the world were trained in France. Many of them stayed in France. I might get myself in trouble with my French friends, but I don't think the French really know how to work really hard the way the Americans and others do. So I'm actually not that bullish. Also, regulation still really punishes companies that grow beyond 50 people. And that's a hard ceiling for startups to deal with. I see this with the French startups I meet. However, I can say that France does produce some enormous technical talent. Yep. And unfortunately for France, the best ones leave, they go to America, they go elsewhere, and they do very, very well elsewhere. And if France wants to succeed, they have to keep them back in France.
Who will regulate AI correctly, if anyone?
Well, you're asking a great question. You remember very well the privacy wars with me from years ago. I was early on the privacy jump, and the regulators missed privacy, right? They lost the march on privacy, and they've been trying to sort of put the toothpaste back in the tube ever since, and Europe has led the way. I do think that they're paying more attention to AI now. I worry that the AI regulating people will be more worried about saving jobs that are probably at risk. So now AI is going to do to white-collar jobs what software and the internet have done to so many blue-collar jobs. Take the example, for example, maybe of auditing, which is big in the UK, but globally. Big Four employ maybe 1.5 million people globally. Good, high-paying, highly educated jobs. The risk is, and I think it's actually not just risk, I think it's a near guarantee over time is my guess, my prediction, that those jobs are just going to be replaced by computers. You can probably do with an AI very soon on a continuous auditing basis a better job than an annual human-driven audit.
Michael, is this your biggest risk for AI, or is it the fact that at some point we won't really be able to tell the difference between a real picture and a fake picture?
The biggest risks for AI are that the computers get smart enough to start telling us what to do or to start acting independently. That is a risk. Is it a
real risk?
Yes, it's a real risk.
10, 15 years from now or longer?
It's hard to predict. These things always take a little longer and then happen much faster than you predict. So they happen later, but then much faster, precipitously, than one predicts. I'm worried about computers managing weapons. I'm worried about computers managing healthcare choices. They are not, after all, humans. They do not, after all, have souls, but they're very, 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 very smart, and they can become eventually sort of semi-self-aware. You know, even the best technologists today don't really understand how neural networks work. They somehow get smarter in a way that we don't really comprehend, but it does happen. So if that's already happening now, 2023, imagine a few years from now how stunning the progress will be. I'll tell you one thing on this point. In 2022, and I'm pretty darn good at this, I was amazed at how quickly AI was improving. And that's when I decided, okay, we got to get all in on this because there's going to be a before and after. So yeah, I am worried.
So this is also because of the chips, right? They get better and smarter. So is the smart money going into trying to regulate AI? Because I guess you need counter softwares, or is it into expanding AI?
Well, you bring up a very good point, because some of the response to AI will be, let's say, counter intel AI, right? So right. So if you're
keep you safe.
Keep you safe, right. And so that will also happen. There'll be an industry for the pro and the con, the before and the after, and so forth. The chip companies are doing very well. As you know, I'm not a public securities commentator, but I am a private investor in some of the most exciting companies in the chip space. I think that will come to compete at the scale of classical compute that the NVIDIAs and the AMDs already are in.
Michael, thank you so much for joining us. Michael Furtick there. Don't be a stranger. Come back really soon. The founder of Silicon Valley VC firm Heroic Ventures. Now, coming up, Sam Bankman-Fried's fall from grace will bring you the details of the crypto entrepreneur's first day in court. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of a foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
The blockbuster trial of the U.S. versus Sam Bankman-Fried is underway almost a year after the collapse of the FTX crypto exchange he co-founded. Well, Bloomberg's Katie Lyons has more from New York.
Sam Bankman-Fried's trial began in federal court here in Manhattan on Tuesday, where he is facing 7 charges related to fraud and money laundering. The trial proceedings began with jury selection. Multiple pools of jurors were evaluated for any bias so that they ultimately can decide his fate here. Sam Bankman-Fried was present in the courtroom on Tuesday. He had a shorter haircut. That signature mop of curly hair is gone. He was also wearing a suit that appeared too big for him. It seems that he may have lost some weight while in detention at the Metropolitan Detention Center. Of course, this case really centers around the implosion of FTX and Alameda Research, the crypto exchange and the separate hedge fund, both of which he had founded. And prosecutors say he orchestrated one of the greatest financial frauds in U.S. history, that he misused customer funds and used them for things like risky investments, real estate, and even political donations. Prosecutors will be aided by 3 key witnesses, all of whom were some of Sam Bankman-Fried's closest associates at the time this all went down. Gary Wong, the co-founder of FTX, Nishad Singh, who was FTX's head of engineering, and Caroline Ellison, his ex-girlfriend and former CEO of Alameda Research. All of them have pleaded guilty to charges and are cooperating with prosecutors. As for the defense, they will likely argue that Sam Bankman-Fried did not intentionally commit fraud. This is something that Bankman-Fried himself has said repeatedly in the lead up to this trial. And of course, he has pleaded not guilty to all 7 of these charges. This trial, though, is going to take some time to play out. It could last up to 6 weeks. And if he is indeed convicted of these 7 charges at the end of it, some of them carry large maximum sentences of 20 years for 5 of these counts. So it is very possible, if he is found guilty, that Sam Bankman-Fried could spend the rest of his life in prison, or be sentenced to it at least. Kayleigh Lyons at the federal courthouse in Manhattan for Bloomberg News.
Of course, we'll continue following that very closely. Also, Sandoz has debuted with a $12 billion market valuation following its spin-off from Novartis. Now, the generic drugs company says it now has more freedom to pursue its own growth strategy. The chief executive officer, Richard Saynor, told Bloomberg about expansion plans.
For the last 7 quarters, we've delivered strong mid-single-digit growth, and that's our forward guidance. Clearly, my priorities over the next couple of years, maintaining that momentum in the business, executing an unrivaled biosimilar pipeline that we intend to launch both in Europe but also in North America, expanding the margin and then driving up the free cash within the business. But clearly, I think we're building credibility, really delighted with the filings and approvals that we've got. As we stand here today, we have something like 25 biosimilars, 5 we intend to launch over the next couple of years, addressing about a $50 billion market opportunity.
Richard Saynor there, the chief executive of Sandoz. Up next, Bloomberg Brief, Danny Berger and Manus Cranney from London and New York. This is Bloomberg.
A lot of the focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know, next fall. But then our take was That's great. You can have these amazing giant general models. What will be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models like really talented graduates that occasionally went a bit weird. It's called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
The boundaries of the entertainment world are blurry, and they're all scrambling for the same thing, screen time. And navigating this multiverse is no simple task. At Bloomberg Screen Time, it's culture, business, converged. Bloomberg Screen Time, Naya Studios, Los Angeles, October 11th and 12th. Get your tickets at bloomberglive.com/screentime.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning from our world headquarters in New York. I'm Menace Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
A sell-off in global bonds gathers pace. Treasuries bulldoze their way through the world markets to the greatest extent since the pandemic hit in 2020, testing the BOJ. The yen retreats as officials refuse to say whether they intervened to bring stability in the FX market. And DC drama adding to the turmoil. Kevin McCarthy becomes the first ever U.S. House Speaker to be removed from his post, increasing the odds of a U.S. government shutdown.
I believe I can continue to fight, maybe in a different manner. I will not run for Speaker again. I'll have the conference pick somebody else.
We'll discuss all of that and the next balance of power political drama with Julie Norman. I mean, Danny, it was a toxic combination for bonds, but there is literally a wildfire cascading across global bond markets. We had the worst day of 2023. There was a propulsion in the bond market yesterday that I haven't seen for a long time. The JOLTS number, can you really put this entire global bond right down to a JOLTS number coming in higher than the Fed had wanted to see at 9.61 million? We have political chassis. It's an Irish word. Crisis is the global word. Chassis in Capitol Hill as McCarthy is out. That should provide, in theory, a bid to treasuries, but we're getting closer to the shutdown. 10-year government bond yields in Germany, the highest since 2011. Aussie rates are praying to catch up with yesterday's session in the United States of America, but they are continuing higher this morning. State Street, I love their swag. When all the world is fearful, they say the Fed will dramatically cut next year by 100 to 200 basis points. I want to give you a vision of the sound of intervention. Let's have a look at dollar yen. This is the moment. We traded up at 150.16 yesterday, and the Bank of Japan, or the Ministry of Finance, I should say, said we have had enough. Down it went, and here's the risk. The Ministry of Finance has not confirmed or denied that they did intervene. And I like what Jane Foley had to say over at Rabobank, which is you might slow the momentum, but they're going to be darn disappointed. We're back at 149. If you intervene in size and scale unilaterally, it might slow the pace for a period, but it will not define the winner of the race. Danny, good morning.
Good morning, Manus. Something certainly feels like it's changed. I think you're absolutely right. Is one JOLTS number enough to do all of this, enough to have that bond picture you just laid out? Equities, they are feeling it. U.S. futures continue to fall. They're now at the lowest level in 4 months after the cash equity trade yesterday ended down 1 1/3%. VIX index, that goes back above 20 for its highest level in 4 months. The curve, it is inverted. In other words, the spot price is higher than contracts that are further out. A clear sign of stress in this market. Somehow, amid all of that, Manus, European equities are higher. Go figure, but just by not even 0.1%. But if stocks are selling off, yields are higher, dollar is higher, the risk picture looks like this, Manus. The risk for the Fed is unduly tight financial conditions. The Goldman Sachs Financial FCON Index is now at its most tight level since we had that hawkish wave in 2022. I'll show you that chart in just a moment. But Manus, the question is, what breaks? Is it bond yields that stop their march higher, you can see here, or is it the economy? Is this threatening the American economy unless we get yields under control, Manus?
Well, it's certainly going to be music to the Fed's ears. The bond market is doing what they can't do. You noted the stoicism of the credit markets. Well, that sort of broke ever so slightly. You're looking at credit market buckling yesterday, Danny. You're looking at some of the highest levels since 2009. And the cost of, I suppose, protecting against junk bonds, well, those spreads are blowing out a little bit, and the CDSs on junk are also becoming more expensive. Danny's never far from an FCON chart. Let's take the conversation to Katrina Dudley. She's the investment strategist at Franklin Templeton Investments. Good to see you. I mean, we've tried to contextualize risk, okay? I think these moves in the bond market are pretty staggering. You're a lot more stoic. You say, nah, calm down. This is just a readjustment.
I think it comes from being a long-term investor. This need to taking a step back and really ignoring some of this short-term noise and looking at the long-term outlook. We're looking at the short-term rates versus the long-term rates. And yes, the market is pricing in 2 to 3 rate cuts next year. But from our perspective, yes, the JOLTS number did come in at 9.6 million. Mm-hmm. There are these job openings that are unfilled. So the economic data is telling you that companies are still looking to hire. And that is the real engine of the economy here in the United States. It is a consumer-based economy, and the consumer is okay.
Katrina, couldn't I, though, also look at the long-term picture and say equities, despite selling off, are still expensive and yields are moving higher? Those two things can't be true at the same time.
When you look at the equity valuations, I think you've kind of got the magic 7, which have been a big driver of valuations. And I think that we're looking at the dichotomy in the market, and that's what's opening up opportunities. Where we're seeing a lot of really good opportunities is in the small and the mid-cap space. And those are not those magic 7, as we call them. These are the names that are very much economically sensitive. And we think that if the economy continues to just kind of move along, we are not in the camp that we will have a great recession in 2024. We're actually probably in the camp today that we may not have a recession. And that's something that's been a slight change in our outlook over the last couple of months in moving from this fact is that we think that the market can muddle through.
Muddling through, but you also talk about, in the equity perspective, you say, look, defensive, look poised for a snapback. You talk about, and I want to get some sort of context around this, you talk about recession or even a more minor catalyst could flip the equity leadership script. Given the dislocation in bonds or repricing, whatever way you want to describe it, I would say we're in a dislocated moment. You say we're just repricing. Can that flip this script? Can we reach a point of where there's a self-propelling philosophy in the bond market and we see a more rapid unwinding in the bond market, and that could tip your equity market?
I have a feeling that people haven't actually woken up to the fact that for the first time in over 20 years, the yield on the bond market is actually higher than the yield on the equity market. And I think that that is the first premise that we need to really start making people aware of, is that there is yield now in the long-term and the short-term bond market. As we flip that script and we look at the equities, yes, you've seen sectors like utilities sell off significantly. They were the bond proxies of the equity market, and therefore I think a lot of that downturn has been priced into these markets. But as we look and as we think of going forward, I think that where you're going to find opportunities is going into areas of the market that will benefit from the economy just being stable.
Katrina, then, if the economy isn't just stable, just lay out that scenario for me where the landing looks something more like a hard landing. How do you need to adjust in that case?
I think if we do see a hard landing, we've got to first put it into the context of why we're going to have a hard landing. And I think the first thing is we do need to see that inflation number break significantly to the downside. We believe that it will have a two-handle by the end of this year. We've been in that camp for a long period of time. But we flip and we say, what else is going to go wrong? Well, I first need corporates to stop hiring, and we really haven't seen any signs of that. The second thing is I need that IRA and the CHIPS Act and the investment that we're seeing to stop. And those are longer-term investments. So even if companies want to stop, you're going to continue to see that tailwind because these are long-term investments. So I need a number of things that are already in place to suddenly reverse for you to have a very deep recession, which is why we have confidence that we're not going to have that deep recession. So it's really just us putting together the pieces. And it's also going back to the fact that we're an active equity manager. We speak to companies on the ground, and I speak to a lot of industrial CEOs, and they are all keeping their labor. And not only are they keeping their labor, they're indicating to the market that they want more labor, and that's what that JOLTS number is.
The other big topic is Japan. I talked about intervention watch from the Ministry of Finance. Again, the velocity in dollar yen is testing the Ministry of Finance nerves. But from an equity perspective, a weaker yen, Japan labor costs are materially lower to a lot of other places in the world. How are the tailwinds for you in Japan?
If I take a look at Japan as a market, I do not think that as a market is very, I know that everyone focuses on the currency. We're actually looking for an appreciation of the yen, and that will relate to the fact that we see a narrowing of those interest rate differentials. But then let's take a look at what's happening in the underlying Japanese market, because there is so much that's in their control. And that is what makes us very bullish. We have pricing power, so we have revenue growth. We have productivity, which will drive margins higher. We have a shift in the culture in Japan to an equity culture, and we have things like the TSE, which is encouraging dialogue with investors.
Right.
So we are very optimistic on the Japanese market, and we don't think it's an optimism that is dependent on the yen and what happens in that market. We think it is internally driven, and if you can find great domestic companies, you actually even take that yen out of the equation.
Katrina, we got to fit this in before we let you go. Kevin McCarthy is gone. It's a divided Republican Party. It's a divided House, 40 days away from a shutdown. Moody's has warned about the creditworthiness given governance issue. How does that factor in to your American equity outlook?
I have just continued to watch the U.S. government get to the brink and come back. So I do fundamentally believe that our politicians want the best for our country collectively, and so they will go into these shutdown negotiations with a positional stance. But what we see is when, like, the rubber hits the road, and you're talking about cutting the paychecks to our veterans, you're talking about the military not getting their paychecks, that they really are good people at heart, and I think that they will work together. But I do think you have got a period of uncertainty as you have positional negotiation going into that shutdown, but we do not believe that we will have a shutdown.
Katrina, your phone's going to go pop, pop, pop. You just called politicians people of good heart. That's the most generous. That's the most generous description to the average politician that I've heard on a global stage. Thank you very much. That is Katrina Dudley from Franklin Templeton, holding her nerve, investing for the long term. Here's some other stories that we are watching. The trending on the terminal this morning, you got Izzy Englander's Millennium is said to be in talks to invest billions of dollars with the rival hedge fund Schonfeld as part of a partnership deal. Now, the investors have been flocking to multi-strategy hedge fund firms like Millennium, Citadel, and Schonfeld in recent years, and it's in the hopes that I suppose the pods of traders will help churn out consistent returns, there's a word, in an increasingly volatile market. Danny, good morning.
Good morning. Well, elsewhere in hedge fund world, Ray Dalio says Washington's restrictions on advanced semiconductor exports to China are similar to the petroleum ban it imposed against Japan prior to the outbreak of war in 1941. Dalio spoke to Bloomberg's David Western at a conversation at the Greenwich Economic Forum.
The reason in World War II, war with Japan, you had the cutting off of the oil and then the sanctioning them taking their payments. So you have a somewhat similar situation. Chips is like oil back then, and it's a very, very, very delicate issue.
And we have a thinner and a less hairy Sam Bankman-Fried showing up at the first day of his trial in Manhattan. There you go. That's the kind of depth that the world looks for. How you look in court. Coming up, we're going to speak to Julie Norman, co-director for the Centre of US Politics at the University College London. What is next after McCarthy ousted as a Speaker of the House? Plus, we speak to Philip Fries at KKR about the state of private equity right here on Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I don't regret standing up for choosing governance over grievance. It is my responsibility. It is my job. I do not regret negotiating. Our government is designed to find compromise. I don't regret my efforts to build coalitions and find solutions. I was raised to solve problems, not create them.
That was the former House Speaker, Kevin McCarthy, there speaking to reporters after being ousted in a revolt for the first time ever. Now, the US House Speaker has lost a no-confidence vote. Joining us now is Kate Ackley from Bloomberg Government. Kate, I mean, the theater was impressive. I was tuned into the networks yesterday. The roll call of votes. McCarthy is out, not restanding, we understand. What happens now?
Yes, it's great to be with you today. It was an extremely dramatic day yesterday on Capitol Hill. Really nothing we'd ever seen before. So now what happens next? Over the next week, there's basically a mostly behind the scenes campaign going on among other House Republicans who are looking to become the next speaker or who are pushing for, you know, their allies to be speaker. And we have kind of a short list of people who are the contenders, the most likely people who could take that spot, fill Kevin McCarthy's shoes. Not surprisingly, some of the names that are emerging are people who are already in House Republican leadership, starting with McCarthy's number 2 person, Steve Scalise. You know, he would be probably the most obvious choice. He's been undergoing treatment for cancer, so that has led to some questions. Is he up for this job, which is obviously a grueling, very demanding job? It requires a lot of travel, meeting with party donors, things like that. He has said he feels well, that he has, you know, it would be up to the job. And, you know, the word was last night that he was making phone calls to potential supporters and, you know, sort of drumming up support like that. But he's not the only one. The number 3 person in House leadership, Tom Emmer, he's the whip.
Yeah.
He also could be a contender as well. And there are others.
Kate, I mean, you mentioned drumming up support. What about McCarthy? He's no longer Speaker of the House, but the man still needs to fundraise. What does this mean for him in that regard?
Well, Kevin McCarthy has been just a huge fundraiser for the party, for other candidates. He's transferred and helped raise millions of dollars for House Republicans and their candidates. You know, he's helped raise money through outside groups that are aligned with House Republicans. So this is going to be at least an immediate hit. Who can step into his shoes in terms of the fundraising? And what will he do with the money that he has left over? He has, you know, over $14 million that are, you know, in his own personal campaign and in his leadership PAC, which is another fund that, you know, he can use to try to win friends and influence people. So we'll be watching what does he do with the money he's sitting on? What does it mean for the party's fundraising going into the 2024 elections? I think there's a lot of skepticism among some donors to the party. You know, this is a lot of uncertainty. There's a lot of confusion about what the House is going to be able to do. You know, you're talking about funding the government after November 17th. So I think there's going to be a lot. Whoever takes over this job next is going to have to reassure the party's donors, as well as the people on Capitol Hill.
Well, let's see. We're inching ever more towards this this vote again on government funding with this leadership contest. So the markets are doubly spooked, aren't they? Kate, thank you very much. Kate Ackley there. Bloomberg Government with the very latest on the exit of McCarthy. Danny, we just got to check in on these bond markets. We really can't do them enough because it's now like a wind fire across the global bond markets. As you see, German yields, they made it above 3% for the first time since 2011. There's a major, Stephen Major note going out saying, look, we're starting to see disruption across other fixed income markets because of higher US bond yields. We are incrementally moving towards 5% in 10s. This is Bloomberg.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger at London HQ. So Ford says it made a new comprehensive offer to 57,000 employees as the UAW strike heads towards its fourth week. This is the seventh offer. It includes a pay raise of more than 20% with less time for new workers to reach that top wage tier. Sources told Bloomberg a little bit earlier that UAW wanted at least 30% of a wage increase and a restoration of traditional pensions. Danny.
Meanwhile, Intel announced a spinoff for its programmable chip unit. Altera will become a standalone business from January 1st through either an IPO or new investment, part of a plan to raise funds for a costly turnaround effort. Intel paid $14 billion for Altera in 2015, Manus.
Now, here's one to pay attention to. Barclays. Barclays strategists have produced a report detailing drugs used for weight loss, like Ozempic, pose a real risk to companies ranging from fast food, restaurants, cigarette makers, and credit market prices aren't fully reflecting the downside. There you go, Danny. Who would have thought? GLP-1 agonists. I didn't know that that's actually what these inhibitors were called, but this is Barclays' big recommendation. Short fast food credit, Danny.
Yeah, I'll tell you, Citrini Research, who was on Odd Lots, the founder, has been way out in front of this. Their trade, Manus, get this, short insulin pumps, short CPAP machines, and short gyms. Ozempic putting businesses out of business left and right, it seems.
Well, I can just tell you, adding to the move to New York, I mean, we'll get to the broker for the apartment next week. But, you know, already splashing out on the gym, it's just multiple costs. But here's the price differential for you. Ozempic in Dubai is 50% cheaper than it is here in the United States of America. Not that I bought any.
Huh, no.
A lot of the focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, deep minds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know, next fall. But then our take was, that's great. You can have these amazing giant general models. What would be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models like really talented graduates that occasionally went a bit weird. It's called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. A sell-off in global bonds gathers pace. Treasuries bulldoze their way through world markets to the greatest extent since the pandemic hit in 2020. Testing the BOJ, the yen retreats as officials refuse to say whether they intervene to bring stability in the FX market. And D.C. drama adds to the turmoil. Kevin McCarthy becomes the first ever U.S. House Speaker to be removed from his post, increasing the odds of a U.S. government shutdown. We're going to be discussing what's next for the balance of power with political expert Julie Norman. Those bond yields, though, that is the dominant story for this market, for this equity market. Is it at a point yet where you need to be worried, where you can't be buying risk because the yield you're getting from the bond market is just too juicy? U.S. futures decline yet again. Yesterday, the cash market fell 1 1/3%. We're down at the lowest in 4 months. VIX, that pops back up above 20. The curve is now inverted for the first time since the bank drama happened in March. This essentially means we're more fearful about this very moment than out in the future. It is a sign of stress. European equities, though, they are moving kind of higher, Manus. Maybe this is a reflection of a slight bit more of calm in at least the European bond market right now.
Yeah, I think give it another couple of hours and maybe that fear factor will come in again. Look, there is a wildfire ripping across global bond markets. The invective was the JOLTS number yesterday, early in the day at 10 a.m. in New York, and that 9.61 million set off a wildfire across the bond markets. 10-year paper are doing their best to get to 5%. I've just had an IB chat with an asset manager in Dubai saying, why are you saying this is some kind of a paradigm shift in bonds? This is just normalization of where we are to a higher rate environment. German rates went to 3% this morning, the highest since 2011. It was the worst day for US bond markets so far this year. The propulsion that you saw drive higher. Aussie rates have put them there because A, they're playing the catch-up game from yesterday, but you have got this propulsion now. HSBC have just put a note out saying what's happening here is really beginning to dislocate across the assets. And then you've got State Street saying, no, don't worry, you're going to get 100 to 200 basis points of cuts next year. And that's why they want to lump up and look large in duration. Now, the oxymoron is I want you to hear and see the size of intervention that in theory possibly happened yesterday. Dollar yen, 150.16 is where she traded, and the theory is the Bank of Japan came in and took us off those lows in yen, highs in dollar. But this is the issue. They have not confirmed whether they were in the market or not. And as Jane Foley says, yeah, they came in and they kept a lid on dollar yen, but they're going to be pretty darn disappointed. We're back at 149. And of course, we saw the first intervention since the 1990s last year. This is unilateral intervention. Unilateral intervention in of itself perhaps cannot stop the trajectory of dollar-yen. You may need something else. Danny, good morning.
Good morning, Manus. And I go back to what Kit Juke said to us earlier this week. You can't have your cake and eat it, too. You can't be defending the band of yields, keeping monetary policy easy, and at the same time trying to lessen the weakening of the yen. You can't do both of them.
No, and you've got to grapple with a whole host of other issues. You've got FCON tightening, you've got credit spreads popping higher, and the cost of insuring junk bonds is also rising. But politics, Danny, politics is the new malevolent force. 40 days of angst in the political desert of Capitol Hill. Danny.
Yeah, it was a historic vote, Manus. U.S. House Speaker Kevin McCarthy was ousted by a small group of radical members of his own party, led by Representative Matt Gaetz of Florida.
It seems very personal with Matt. It doesn't look like he's looking out for the country or the institution. If you throw a speaker out that has 99% of their conference, that kept government open and paid the troops, I think we're in a really bad place for how we're going to run Congress.
You have paralyzed the House of Representatives today. To whose benefit? People have called you a narcissist. People say that it's to your benefit alone. Is it to the benefit of you and to Donald Trump?
It's the benefit of this country that we have a better Speaker of the House than Kevin McCarthy. Kevin McCarthy couldn't keep his word.
Joining Manus me today is Julie Norman, co-director for the UCL Center on U.S. Politics. Julie, the Democrats didn't come to Kevin McCarthy's rescue. You write, Democrats miss an opportunity to go high and push back on this brand of politics. Julie, what should the Democrats have done in this circumstance?
Well, look, Democrats certainly had no love for McCarthy after the last 9 months, and especially with McCarthy putting forth the impeachment investigation and going back on some of his promises regarding the budget and other kinds of agreements that had made. I could definitely see why Democrats were not feeling the love to bail him out. But with that said, this kind of maneuver that we saw from Gaetz really is just a new kind of politics. It's not only bad for the GOP and for the Republican Party, but it's bad for Congress and the institution. And I do think for Democrats, they had an opportunity, if they wanted to take it, to go high on this one, to push back at Gaetz more than McCarthy and say, look, we're not happy with some things McCarthy has done, but this kind of antics that we're seeing from Gaetz isn't something we want to reward or see repeated. And at the end of the day, McCarthy did come through with some very important bipartisan agreements, avoiding a fiscal cliff, avoiding the shutdown, and that's something that I think some Democrats, I think, might regret having someone in that position who wouldn't make those decisions in the future.
I mean, if the Democrats, Julie, good morning from New York, if the Democrats had got in behind McCarthy, the accusation would be that they're supporting a Republican agenda with various components in it that do not sit well with many factions in the Democrats. It wouldn't have played, do you think it would have played better for them going into the general election that they kept government open and running, as it were, rather than doing nothing?
Well, I mean, a year from now with the elections, I think we'll see how much this stays in the memory of many voters. But you're right that there was been a political risk in backing McCarthy. At the same time, though, there are numerous things on Democrats' agenda that do matter to voters. People don't want a shutdown. They want the budget to be settled for next year. Investors and those watching Bloomberg don't want unstable markets. And for many other Democrats, they want to see aid to Ukraine. They want to see other priorities moving forward. And none of that can happen when the House is thrown into this kind of disarray and all the focus for the upcoming weeks has to very necessarily be on the speakership.
So tell me then, Julie, in 40 days from now, how likely is another government shutdown?
Unfortunately, with what happened yesterday, a shutdown is more likely than less. We knew already it was going to be a bit of a struggle to get to some kind of agreement, even with someone like McCarthy, who was willing to maybe make some concessions, willing to maybe make some deals. I don't think that there's going to be a speaker in that position next who is either willing or able to do that. Remember, McCarthy was operating under very strict constraints from his own party. I don't see them letting up on that with whoever is in that new position. So I can expect in November we'd see something very similar to what we already have seen, but perhaps with a little bit less leverage for those who are willing to look for a deal and take a more moderate approach on this.
So we're showing some of the faces of the names who will run for this role. Steve Scalise, as we understand it, has health issues. You've got Emma there, McHenry and Cole. Which of these has perhaps the best potential to deliver a government that remains open and no shutdown? A very fast first take.
Yeah, I mean, I think it's too early to say who will actually get the position. I think Steve Scalise is probably the best positioned right now to carry on the kind of leadership that we saw from McCarthy. He was the number 2. He was pretty loyal to McCarthy throughout, even up through these last several days. So I think that's where a lot of the focus will be. But as you said, there are others whose names are certainly being floated as well. And we'll just have to see as the votes go. Obviously, it was not easy for McCarthy the first time around, 15 rounds, and it probably won't be very easy for any other individual either.
Meanwhile, Julie, the market is in meltdown mode. Some of it is not tied to this, but some of it is tied to a ballooning government deficit, at least on the long end of the curve. Goldman Sachs is out with a research note saying that servicing costs for debt will reach 4% of GDP by 2030, given to how yields have moved. Julie, what is the reality for this next government when it comes to the American fiscal position?
Yeah, well, I think the reality is that there needs to be some cooler heads in the room who can actually look at the more mid and long-term implications of what's happening now economically and financially. And what we're seeing instead is both parties playing this very short-term political gamemanship that is maybe politically shrewd for electoral purposes, but really aren't moving us forward on the big questions that we need to be thinking about in terms of the U.S. economy for the long term.
Julie, the risk is this. There is a political vacuum on the Republican side. The issues have not gone away. Ukraine, border control, and fiscal largesse. We still have these 3 issues. Whoever takes over, do you not think that the GOP are going to push harder and harder on the new speaker on these 3 very core issues? Are we moving so far away now from any possibility of coalition politics?
Yeah, I think we've been moving away, and I think the new speaker will throw that into even more of a kind of polarized situation, but even more so just 2024 and the election year. We know that issues that have been simmering for a while, like a growing antagonism to Ukraine aid, those have not really been at the forefront that much yet, but I think they will become increasingly wedge issues in 2024. Obviously, the border, an ongoing issue that I think many in both parties are keen to address and see some movement on. But again, in an election year, it's harder than ever usually to get that kind of bipartisan cooperation, and whatever restrictions this new speaker is under will make that just that much more difficult.
Julie, really wonderful to get your thoughts this morning. Julie Norman there of UCL. Now, coming up, we're going to be speaking to Philip Freiza of KKR about the state of private equity as bond yields and borrowing costs march higher. This is Bloomberg.
Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger at London HQ. There's only one story, Danny. It's the bond markets. We are in the mood to kiss 5% on these bond yields, will we? It's about real yield back in the market, 30-year government bonds. The biggest bond, the worst day for global bonds that we've seen in 2023 yesterday. Some of the moves were really quite stupendous. HSBC have a note out saying these moves in the bond markets are starting to cause worry across all assets. We have a buyer's strike at the moment in the bond market. Japanese government bonds, they're going to test the mettle of the Bank of Japan. And Germany, of course, made it to the highest level since 2011, Danny. Not only did we kiss 3%, but we traded at 3%. Good morning from New York.
Good morning from London, Manus. And this idea that it affects all assets, the question needs to be asked, does it also impact private capital? Because it's clear what's happening in public markets. Joining us now for an exclusive conversation about the environment for deal-making in private equity is Philip Freiza, KKR co-head of European Private Equity. Philip, I feel like you always join us on a drama-filled day, so it only feels right you're here when bond yields are touching new highs. You have a public market that's come to terms with this higher for longer narrative. Has private equity come to terms with it?
Well, Danny, good morning. Thank you for having me on. And I would first say that we wouldn't consider it as drama at KKR. I think you had my partner Henry McVay on multiple times. We see it as a normalization that was to be expected after 15 years of extraordinary monetary and fiscal support that is now being withdrawn. We are expecting inflation to remain longer, higher for longer. And as a result of that, as a firm, the way we invest in private equity is very razor focused on the new environment, which means you got to go to people and offer them more than just capital. In this turbulent environment, they actually want a partner who helps them navigate that environment, whether that's with operational support, whether that is through the global platform that we have, or whether that is through KCM, our capital markets business, which helps them actually navigate those turbulent debt markets.
So that's what changes on the deal origination side. What about the debt side and getting financing side? What changes there with higher for longer?
So I would start to say you saw in September, the European leveraged loan market was actually quite constructive. I think 8 billion euros compared to 9 billion in June is a healthy level. The European leveraged loan index closed at 96, a little over 96, so it's up for the months. So we actually see a bit of a thawing in that market. It isn't as difficult as it was at the end of last year. So at the end of last year, 22, if you wanted to do a deal, as by the way we did with April in France, you almost certainly would have relied on a club of private lenders. And that would have been done in the kind of 600 to 650 basis points over territory. You now have a term loan B market in the leveraged loan market, which is in the 400 to 450 handle. So while interest rates are rising, you pointed that out, spreads are still compressing relative to the very distressed levels end of last year, which is constructive for private equity.
So constructive environment. Good morning, Philip. Good to see you. Tell me this, in terms of the competitive landscape, the market is opening. The world that I've just come from is Saudi Arabia, the UAE, with the likes of Mubadala, with the likes of the PIF, etc. To what extent are they a direct competition to you now? Are they heating this market up in terms of going after the same deals as you?
This is a very important region for our industry. They are close partners to us. They have been for many years. We have a constructive dialogue with them on some of the things we are focused on. As we discussed with Danny, what we believe in to navigate this environment, you got to be thematic investors. On the one hand, we believe, for instance, digitization has not run its course in Europe. An aging, demographic opens many opportunities in healthcare. And then, of course, we have that massive energy transition, which creates opportunities. This region wants us to partner with them to tap those opportunities. Therefore, to answer your question, we see them as partners, not as competition.
Now, there certainly has been a lot of stress among portfolios, given the cost of capital is moving higher. I know you had to hand back the keys for two companies, Envision and UNSA. What went wrong? Is that related to the higher cost of debt?
So I would say generally, if you think about our portfolio holistically, it's performing robustly. We are razor focused on risk management and portfolio construction. It's part of our job to make sure that in a portfolio of 20 companies, the majority perform strongly. I think this year we're expecting both double-digit growth on the revenue and on the bottom line. And then, of course, you always have certain circumstances that are tougher that we work through, hand in hand with our bank partners.
Well, part of the reason I think of it, Bank of America, I believe it is, had this note out saying 2024 private credit defaults would be 5%. I mean, that's pretty low, but it's higher than it has been. Obviously, a lot of private credit is going to be borrowed by companies like your portfolio companies. Does that level sound right to you?
So, I mean, I speak for KKR, right? In terms of the industry, there had been certainly circumstances in the boom of 2021 where there was too much leverage used. We have used on average 4 times across our portfolio. In fact, if you look at the 2 most recent deals we have done, OHB, the German space deal, and FGS Global, which is a global communications agency, we have actually financed those deals without any leverage. So, between 2009 and 2020, the average interest rate was 0.7%. Definitely, we are in a different environment now. I don't think we'll see default levels creep up to a dangerous level, but we certainly will see them creep up.
So tell me this then, we're grappling with what higher rates means. The bond market is, the equity market is, private markets as well as debt. When you look at the 2 big IPOs that Danny and I have covered recently, which is Arm, obviously listing here, and Instacart, both are back below their IPO levels. How would you describe that exit environment at the moment? These were very Arivest moments on the IPO calendar. Should we be excited? Is the landscape really opening up?
I mean, look, it's normal human behavior that after a long period of distress, crisis, turbulence, that people really hope that the next boom is just around the corner. Unfortunately, the next boom is not just around the corner. This is going to stay tougher much longer. Great companies will have space to go public, but you will not see what we saw before, a large series of IPOs with companies of average quality. We see at KKR the environment to be tougher longer, which again, I would say, which is really interesting, we have not seen, and I've done this for 22 years now, as much interest in public company CEOs, in entrepreneurs and families to take their companies private today than we've ever seen. Because people realize that having the public markets as your partner is not as helpful as a private equity partner who can help you to navigate this space.
That sounds like a permanent change, though. That sounds like more than just higher rates. Is that a permanent change, just from here on out, less IPOs?
I don't think it's a permanent change. I think what capital markets really hate is uncertainty. It's not a bond route we are seeing now. It's just a normalization. I mean, Jamie Dimon talks about the fact he believes that rates will have to go to 7% before the market normalizes. Others expect it to be a little higher than 5.5%. Who knows? So the market is trying to find its footing in terms of knowing what the outlook is. The moment we are through this and know a little bit more where the outlook is, things will stabilize and the window will open more sustainably.
Right. I mean, Birkenstock's going to IPO. Manus and I have been debating about whether you'd buy Dior Birkenstocks. Would you, Philip? Would you spend $1,000 on Dior Birkenstocks?
I'm Kenough.
They're a German company, though. You got to represent. I guess you are not so. Philip, really wonderful to have you on. Thanks so much. That's Philip Freiza, KKR co-head of European Private Equity. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Let's get you set up for your trading day now and take a look at what is ahead. We're going to get U.S. PMI data coming out at 10 a.m. Eastern. We're going to have more Fed speak from Fed Governor Michelle Bowman and Fed President of Chicago, Austin Goolsbee. Then in the next hour, UK Prime Minister Rishi Sunak is taking the stage at the Conservative Party's annual conference in what would be the biggest speech of his political career, tax implications under pressure. Now, the fraud trial for FTX co-founder Sam Bankman-Fried continues as opening arguments start today. The 31-year-old pleaded not guilty to 7 counts of fraud and conspiracy. And Manus, as our BN team laid out, he's thinner and less hairy. I'm going to be honest, I don't know what to make of that.
Well, it's all about presentation in the courtroom, isn't it? But how do you present? How do you get equity investors to hold the faith? We've got this fairly vertical move in rates. I thought I'd bring this to you. This is about the premium that you've got left in equities relative to bonds. There's only 33 basis points of earnings premium in the SPOOs compared to the surge in 10-year yields.
And at the same time, we're just talking to Julie Norman. Bond proxies like utilities under pressure with that higher yield in treasury markets. She still likes equities. Fine valuation, Manus, beyond the big cap tech into small caps and things that make sense. Good morning from London.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
This environment was clear from early 2022 that we could be back in a 4, 5, 6% interest rate environment.
Rates are a very self-correcting sort of thing.
What we need stability. Rates don't need to go down from here. What we're seeing is the underlying fundamentals are still good.
Businesses are looking at the fact that the cost of capital is rising and they're starting to pull back on investments.
The higher for longer is coming to a reality where the market's been in denial of that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a move in this bond market. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity market trying to stage a recovery, just about positive on the S&P 500. The moves overnight in the Asian trading session, briefly, 5% on a 30-year yield and very, very close, TK, to 4.90 on a 10-year.
The mathematics here is really important, and we don't do math this early in the morning, but really, John, on a pro basis, is from a careful analysis of convexity to looking on a vector down, free fall. Something changed yesterday, and the mathematics went out the window. This is a morning of price analysis of fixed income, and not to be inflammatory, but it borders on free fall.
Oh, price has been absolutely hammered, that's for sure, particularly over the last couple of months. Lisa, looking at this move right now, currently yields higher by 2 basis points, 481.46 on a 10-year maturity. Overnight, Bramo, 487.99 on a 10-year.
What's the circuit breaker? It's not coming from Washington, D.C., that's for sure, because this doesn't seem like there's going to be any resolution there without leadership. It's not going to necessarily come from the data being weaker than expected, with job openings coming out stronger than expected, and the manufacturing numbers also better than good, to quote Tom. So at what point do you get a circuit breaker from something other than just people who start to buy?
This from Isaac Boltanski over at BTIG on a speakerless house. This is what he had to say. Over the long term, ousting the speaker in this manner is wholly consistent with broader structural concerns regarding American political dysfunction and the country's debt trajectory. TK, those two stories are not separate. They are combined this morning.
I watched it in real time, trying to explain this to cherubs at the dining room table last night. I thought that Mariana Sotomayor in the Washington Post captured it brilliantly. And John, this goes back to my grandmother on the couch who knew Union soldiers in the Civil War. And she was inflamed by the phrase Civil War. She said, Tom, it was the War of the Rebellion. And the Washington Post this morning led with that historic word for Washington, rebellion.
AMH coming up a little bit later. Back-to-back double-digit moves on a 10-year yield coming into Wednesday. Check out the equity market on the S&P 500. Closing yesterday at the lows we have not seen since early June. This morning, just about positive by 0.02%. We need to talk about the financials later. We'll do that this hour. The charts of Citi and Bank of America over the last few months are not pretty at all. Yields up a single basis point, 481 on a 10-year. The dollar showing some weakness after really dominating G10 over the last couple of days. Euro dollar here, Lisa, 104.96.
What an interesting time, and the economic data just keeps coming in stronger than people expect, which is part of the reason why. Again, what is going to stop this? It's terrible. Okay, no, it's not. But at the same time, it raises this question about inflation. Today we get 8:15 a.m. U.S. ADP jobs report. People discount it, although maybe not if it comes out, especially with an upside surprise. And 10 a.m. we get ISM services data as well as factory orders and durable goods. Yesterday, this is what turbocharged the move. Job openings surprisingly increased, not decreased as expected. That perhaps gave another leg higher to some of the yield move. Today, the OPEC Plus coalition due to hold a meeting of the Joint Ministerial Monitoring Committee. Basically, are they going to keep cutting their production? Are they going to keep the cuts in place, or are they going to increase at a time where crude is still one of the things pressuring inflation, pressuring some of the yields? Although it seems to be that the OPEC Plus members like this. And Fed Speak today includes Fed Governor Michelle Bowman at 10:25 a.m., Chicago Fed President Austin Goolsbee at 10:30 a.m., as well as later in the afternoon. Do they start pushing back on the yield move at the pace?
The most interesting thing yesterday in a blur of an historic day was Secretary Yellen beginning to talk up monetary policy. In proxy for Powell, I don't know. But Goolsbee, the debate student out of Milton Academy in Boston, can take a more behavioral construct here. And to me, it's just real simple. We're all going in search of the Powell put. When is the chairman going to go, okay, we've been doing this, and it was good to see John and wave at Lisa at Jackson Hole, but, and there's going to be a change.
Well, the but right now, Tom, is the economic data. Monday, ISM manufacturing, less worse than anticipated, better than expected. Yesterday, job openings absolutely exploding higher. And the real risk coming into Q4 wasn't that will we just get this test. There was two-way risk. It cuts both ways. It wasn't just about the consumer test coming into Q4. It was also about the risk that we re-accelerate in the economy going into 2024. That idea was pushed by Andrew Hollenhorst of Citi and also Neil Dutter of Renaissance Macro. And the data we've seen over the last couple of days, Tom, if you plug that in, you raise the risk. I think you have that risk on the table they've got to grapple with, that risk can cut both ways. It's not just a slowdown, it's also a re-acceleration.
Hollenhorst with us later this morning. It's going to be fascinating. And John, all of this with a backdrop of a disinflationary vector. We are going to look to Washington today. I spoke to Anne Marie Horton after her exhausting day. She has, I believe, an interview today with a guy named Gates from Florida.
Congressman Gates, yeah.
He stood her up last time. You don't stand up.
I would say that this was a better time to do the interview. I think so. A little bit later, 5 p.m. Eastern time.
Yeah, tonight later. And we'll
balance of power.
We're going to focus on Washington and the history made yesterday, but right now on the history of this market in crisis, and when in bonds, it becomes about price and not yield. Margie Patel, honored to have her with us from Allspring Global Investments, Boston, this morning. Margie, you know, all the bow ties go out and they spout about yield, and there's a point when price matters. What do we do about a lower price in bonds, notes, and bills?
Well, I think we've had happen over the last year something we haven't seen, I think, ever, and that is that I expect the spread of treasuries over corporates and high-yield bonds is going to stay much narrower than we would think with the big increase that the Fed has made in short rates. And so I think that that's one of the things that's puzzling people. And really, when I look at treasuries and say, well, they're 4.5%, 5% with inflation at, say, 3 or 4%, that doesn't seem to be restrictive at all. And so I would expect that corporate bonds, high-yield bonds would stay in a narrow trading range.
Margie, I'm going to go back to 1998, and I'm sure at Lock Obers there was a lunch of Felix Smith, Dan Fuss, and a younger Margie Patel. And what it was about is where, things begin to sweat. Do you have a sweat about our banking system? I'm not saying, do you own the banks? Do you want to own the banks? But are you worried about the financial integrity of our different capitalizations of banks?
No, I think the banking sector is in good shape because of the increases in quality and regulation. And also, they have not been going crazy making bad loans over the last few years. Corporations have extended their maturities. We haven't had a lot of big mergers and acquisitions. So I think the banks are okay, and I'm not looking for any kind of a financial crisis.
So, Margie, why is Citi? Why is Bank of America trading below the lows of spring?
Well, I think it's because people are expecting that they aren't going to have the net interest margin that we had thought or hoped. And also the loan demand isn't really there. Banks don't want to make loans. They certainly don't want to make aggressive loans. So it's hard to see where the earnings growth will come from compared to other sectors.
So any reason to buy them going into earnings season, looking ahead to JP Morgan next Friday?
Well, the problem is that it's hard to see that they can have a breakout and on the upside have above average earnings, but on the downside, if rates continue to go up, loan demand is pretty muted. It's hard to see that that'd be very attractive either way.
On a relative value perspective, Marky, at what point do some of these higher Treasury yields challenge your thesis about stocks, challenge the valuation prospects that we've been looking at? Just because on a relative valuation, you're getting more in yields on 10-year Treasuries than you have in the earnings yield on the S&P 500 going back to 2002.
Well, I think that reflects the actually supply-demand. I think one of the reasons treasuries are so high compared to other parts of the bond market is simply there's such an enormous supply of treasuries. High-yield supply is down, investment-grade supply is down. So people who are looking for those securities are going to bid that spread narrower.
At the same time...
So I think no.
Okay, so you think no, but at the same time, there are a growing number of people, including Stephen Major over at HSBC, who disagree, who think that actually we are getting to a point where the relative value of full faith and credit in the U.S. government is actually getting much more attractive relative to the risk and the potential volatility in stocks, especially if you strip out the Magnificent Seven. Why do you push back? Why do you say that even if you're getting more yield in bonds, that's not necessarily going to shift you away from equities?
Well, number one, there's really no guarantee that Treasury rates have peaked and are about to go lower. There is a chance they could stay at this level or even go higher, again, because of this enormous supply. And when you look at the stock market and you exclude that handful of stocks that are trading at very high price-earnings ratios, there are lots of sectors of the market that are trading very, very reasonably and that actually have a cash flow yield competitive with short-term Treasuries.
Marky, there's so much confusion right now because there's so little conviction as to what is driving this bond market, particularly at the long end. I've said a few times over the last few months, asked 5 people, 5 different reasons. QT, rates are higher. Pick your poison right now. Look abroad. China. What is it? Is it the budget deficit in the United States? Is it the dysfunction in Washington, D.C. this morning and over the last week?
Well, we've seen a big increase in deficit financing from governments really around the world, and the U.S. is part of that trend. And it's only a couple of years ago that I think 15% of global bonds outstanding had negative yields. That's not an issue anymore. Yields have pretty much moved over to the positive side. So I think it just says that interest rates were abnormally low. Now they may be average. They could even go to be a little abnormally high. And that really doesn't affect the fundamentals of the stock market if we continue to have growth. And corporations are in very good shape. They are not over-levered. They're very cautious about capital expenditures.
Marty, I got it out, Margie. I've been up all night. Margie, I want to give some historical perspective here because you're too modest to talk about it. 1 year, 3 year, 5 year, you're solid 80th percentile plus. Your Sharpe ratio, which, folks, is all I look at of the 3 ratios, your Sharpe ratio is demonstrably superior to your peer group. And basically, you're a bond person who's been hugely skeptical in recent years about bonds. What do you say to people that bought the bond story and are looking at nominal returns wiped out for X number of years or inflation-adjusted returns wiped out for a decade? What should the people that have been clobbered in bonds do?
Well, I think they should examine why they accepted kind of outdated ideas about what determines bond prices and bond prices versus equity prices. And I think, again, the supply-demand factors come into play even on the bond side. We have an enormous flood of treasuries. There's no end in sight for that. So that makes the returns from other asset classes, whether it's high-yield, investment-grade, or stocks, look relatively more attractive because they don't have this huge amount of supply that's going to keep coming and hitting the market. It needs to find buyers at higher prices.
Margie, thanks for the input
yields,
this morning. Margie Patel there of Allspring Global Investments. Do we need much high yields to find buyers from here? Gene Tenuzzo from Columbia Threadneedle later this hour, about 20 minutes away. Look out for that conversation. The moves yesterday did spark a policy response. Maybe. I say maybe because we're not sure. Dollar yen very briefly breached 150 This was the sequence of things, TK. Job openings in America come out much higher than anticipated. Yields up, dollar stronger. Dollar yen blows out through 150. And then all of a sudden, gap lower on that currency pair. The Japanese authorities refusing to confirm or deny whether they were intervening yesterday off the back of that, Tom. Keeping us guessing, but ultimately the chart speaks for itself. I suggest you all pull up that chart if you haven't seen it already. Dollar yen through 150 and then gapping lower all of a sudden.
Gapping lower, but what's important here on second intervention, I'm going to use that, I'm editorializing there, but on second intervention, John, they made a massive move from, say, a 149.80 down to 149.10. It was a bold move. This was a BS intervention, and, you know, we'll have to monitor it. They don't have an obligation to tell us.
Is that a balance sheet intervention?
No, it's not a BS.
Something else.
It's something else. Yeah, and the answer is, you know, there's a whole history fraught here. Ken Rogoff and Rudy Dornbush have been brilliant on this. A guy like Eichengreen out at Berkeley, and the answer is, it doesn't work.
This is the issue.
Thank you.
Maybe it can do something about the pace, Lisa. Perhaps it can slow things down, change the trajectory, do something about the fundamentals.
It means that we're going to get to 149.99 again and again and again. I mean, that's essentially what we're going to do, is because that's the line in the sand. They reiterated that yesterday. Although maybe not. Maybe it's not intervention. Wink, wink. Nod, nod. Everyone's basically saying yeah.
I'm going to tear up, John. Bring that
yeah, exactly.
I know.
On radio, this chart looks
149.10
perfect.
on dollar yen. Coming up next hour, Jay Poloski of TPW Advisory from New York City. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
All eyes turn to the U.S. job market.
The jobs report, it beckons.
It looks like companies are just holding on to workers.
What you see is what you get. We're seeing a lot of strength.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is exactly what the Fed is looking for.
They now believe you can get back to 2% without damaging the labor market at all.
We might get a bigger whammy than we expected.
The September Jobs Report, Friday on Bloomberg Television and Radio.
On this vote, the yeas are 216, the nays are 210. The resolution is adopted. Without objection, the motion to reconsider is laid on the table. The office of Speaker of the House of the United States House of Representatives is hereby declared vacant.
Historic day in Washington as the House voted to vacate Kevin McCarthy as House Speaker. Welcome to New York City. Check out this market. Equities just about turning positive on the S&P 500 after a deep day of losses yesterday, taking us back to the lows of early June. This morning, positive by 0.04%. Overnight in the Asian trading session, some big moves in the bond market. Yields up by a single basis point at the moment, 4.81 on a US 10-year, on a 30-year, briefly through 5%, up by a single basis point currently on a 30-year at about 4.93. Outside of that move in foreign exchange, the euro trying to make a comeback here and show some strength, facing the potential of a 12th week of euro weakness against dollar strength after 11 weeks of it closing out last week. 105.010, or rather 105.10, 105.10 on the euro against the dollar. That currency pair positive by 0.4%. And maybe the stress in the bond market starting to get people to think about the end of the cycle. Credit spreads wider, discretionary stocks struggling, bank stocks struggling, crude lower. 88, Tom. We're down about 1% on crude.
You can't imagine if crude goes the other way. Of course, Edward Morris has made a real splash here on crude coming back. But really, other than the calming influence of crude, 97 down to Brent crude, just under 90, 89 at 92. I mean, I'm looking at the screen this morning, John, and you got to wonder what meetings are being quote unquote taken.
Between who?
In Washington, among institutions responsible for supervision and to an extent regulation, but also at these banks. I mean, what's the year-end plan? There's no year-end plan. There's an October plan, and you better get to it.
Add some extra spice to earnings season and those earning calls that start next week with JP Morgan 2 Fridays away. We've said a few times on this program, trying to frame what this bond market move really is. Is it a reflection of the extension of the cycle or a recipe to end it? I'd have to say, if you asked that question maybe a couple of months ago, it was the former. It starts to feel like over the last couple of days it might be the latter, just in terms of where this market is leaning. I'm looking at high yield spreads, not the level, but the way we've moved. I'm looking at discretionary stocks. Once again, great year, but struggling recently. And looking at bank stocks, Tom, to see the likes of Citi and Bank of America trading below where they were at the spring lows, post the tension of the financial sector earlier this year, Tom, that's quite something going into earnings season.
Yeah, the fancy bow tie word convexity means you're in control. Lisa, were we in control yesterday?
It depends who you mean as we. Maybe the bond vigilantes were. So. That's a good question.
I don't know. I think it's going to be sport. We're going to turn to Washington right now, and of course, with the leadership of Joe Matthew and Anne-Marie Horton, Balance of Power has become must-watch in Washington at 5 p.m. Look for that tonight. A gentleman from Florida by the name of Gates is scheduled to show up. This is really special, and we thank Invesco for letting us speak this morning to their head of U.S. government affairs, because yesterday afternoon, in that history-making moment, the bow-tied one got up at the House and said, "We will continue forward." His name is McHenry. He's from the Carolinas. He's a really interesting guy working in the trenches of political operation for George Bush the Younger and on through Carolina politics. Jennifer Flitton is with Invesco, head of U.S. government affairs, but has worked for Congressman McHenry over the number of years in chief of staff positions. Jennifer, thank you so much. Who is this guy? It was like Butch Cassidy last night. We know these faces, and to be honest, most of our audience, particularly our international audience, who is the Southerner, McHenry?
Yeah, well, he's the chairman of the Financial Services Committee, and he has been in Congress for almost 2 decades now. He is an institutionalist, and he is a policy wonk, and he's politically savvy, and it's not shocking that Speaker McCarthy chose him on that short list of members to succeed in time of emergency.
Jennifer, in the Washington Post this morning, Mariana Sotomayor, they lead with the word rebellion. That has a heritage, a tenor, a tone south of the Mason-Dixon line. Parse the distinction of Southern Republicans like French Hill of Little Rock or Mr. McHenry of the Carolinas. Parse their distinction from 8 or 9 people that have rebelled.
Yeah, these are fairly new members, right? I mean, you look at these 8, and these are members who mostly came in after 2018, and they really represent a different thinking within the Republican Party that was made very clear after the election of Donald Trump. And it really is a small number, right? I mean, the vast majority of the Republican conference stood behind Kevin McCarthy, but due to such small margins in the House, a vote of basically 5, 8 members were able to unseat the speaker for the first time in history.
Jennifer, I was reading a story interviewing some of the supporters of Congressman Gates in Florida, and they were very supportive of what he was doing. And they were saying, basically, the system hasn't worked for us. Throw it all down. Basically, take it apart. Why are there so many voters who essentially want to disrupt the whole system? What's the galvanizing force behind that?
There's a frustration, right? And Washington is but a reflection of a lot of that frustration. These are 435 members of Congress of the House who come to Washington to reflect their constituencies. And there is a frustration. There is sort of a distrust in Washington. And yes, Matt Gaetz has decided to come in front of that and in his expression to try to lead that. But it does actually reflect a concern over a $33 trillion debt, a $1 billion of interest being paid every year, right? I mean, so that frustration is real. Whether Matt Gaetz is necessarily the best to be the voice and the leader of that, I think is an open question.
But the irony of this, Jennifer, is that the longer the government doesn't make a resolution, the more bond yields are going up and the greater the interest expense and the debt profile of this country. So at what point, from a political standpoint, can you bridge that gap to try to communicate that sometimes dealing with the frustrations and the inefficiencies of the system are maybe a more efficient way of getting to the same end? I mean, how do you communicate that politically?
Well, and I think we're going to see exactly that as they negotiate this appropriations process over the next 42 days, right? Because they have until November 17th to either pass another stopgap resolution or to come to an agreement with the Senate on appropriations. And right now, they're still very divided. Whoever is the next speaker is going to have to, as you say, bridge that divide. And I think it's an open question. And over the next week, these Republican members of this conference, from the center to the far right, are going to have to grapple with that question.
Jennifer, do you have a base case on where we'll be November 17th?
I'm concerned, right? I mean, last night was very concerning. And I think there's an understanding within the conference that there needs to be unity among the Republicans if they're going to move forward and have any leeway with the Senate going forward. But it is clearly going to be difficult for any new speaker to work with the Senate, which quite frankly has a bipartisan position on appropriations. So at this point, at this date, I'm rather concerned how we're going to move forward. And I think a government shutdown is probable in the near term.
Jennifer, thank you for your insight, your opinion. Jennifer Flibben there of Invesco. November 17th, Bramo, base case, just to read between the lines there, basically said it at the end, shutdown.
And we heard that from Jim Jordan as well. We heard that from others, that it doesn't seem like there is some sort of resolution. The problem is, and this goes to the frustration that a lot of people have, both in Washington and outside, people are not happy with the way the system is working. But if you just throw it out, you get further away from a solution to the very same problem, which is bigger deficits and bigger interest payments.
Remember the Fitch downgrade?
Yes.
And all the criticism that Fitch got?
Yeah, here's S&P, right?
Even the administration was coming out and saying, what dysfunction?
Exactly.
Like, come on. Look at the way it's playing out. Look at the way it's playing out now. Coming up on the bond market, Gene Tanuzzo of Columbia Threadneedle on fixed income and this global bond market sell-off. Yields this morning, I have to say at the moment, quite well behaved. Your 10-year, 480 from New York. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of a foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Yields pop, stocks drop. That's the story of the last 24 hours or so. Your equity market pulling back on the S&P 500. Futures just about unchanged this morning, up by 0.03% on the S&P 500. The S&P, Tom, down almost 8% from the highs of July.
Yeah, I got a drawdown. I mean, the drawdown here is not all that bad. We're not even to correction status here in the equity market. As you let off, John, equity's doing better than bonds as a general statement. I got a negative 7%, negative 8%, Dow doing a little better than SPX. But what's surprising is NASDAQ. You know, I expect negative 8%. I expect NASDAQ to be negative 10, 11, 12. No, NASDAQ's holding up because of those profit machines, which aren't going down like the others.
I'm with you. Given the moves we've seen in the bond market, back-to-back double-digit gains on a 10-year yield, a move of more than 20 basis points Monday, Tuesday. Thank the manufacturing ISM. On Monday, on Tuesday, you can maybe thank job openings or thank everything, all of the above. Yields are higher by 2 basis points this morning. Let's call it 482. Came very close to having a little look at 490. But let's frame this move as follows, Lisa. This is a 150 basis point move from the post-SVB failure lows. That's how big this move has been. And remember going back to spring when we had conversations day after day, again and again repeatedly, about the potential for the end of the cycle. Here we are with yields 150 basis points above those lows.
It's defied all expectations, including those who said something would break at this point, and we've heard that again and again. Maybe things are starting to break, but doesn't seem like it really. I just was laughing when you said, here we are, a tame move, 482. Yesterday at the same time, you said, you know, bumping up against 470. I mean, it just gives you a sense of how fast we're moving here.
Exactly, the speed of movement, and fast is a really important word. It's a famous David Malpass word. The bank, I looked it up, the bank rate 30-year, I was shocked, 7.88%. It's like jump condition towards 8%. And what's amazing to me is the 30-year bond, John, you mentioned correctly, at 2-something a.m. this morning, it popped to 5.00, take it out to, we do 3 digits here at Bloomberg, 5.009%. The world changes.
It feels like 5 minutes ago, Lisa, to your point, we were literally discussing how historic it was to get yields back in the 440s on a 30-year, that we hadn't seen this in something like 10 years, and we're just taking out each and every level so quickly at the moment.
Which is the reason why it was interesting to me that Margie Patel, her argument for stocks is that we don't know whether this yield rise is over. It could rise that much more, and we could actually see more material losses because of the supply issues, because of the dysfunction in Washington, D.C., because of what we're seeing with robust economic data, and that could still allow stocks and riskier securities in the bond market to keep advancing. Is that the case? Really, this is, to me, the key debate heading into the fourth quarter.
Let's wrap it up with foreign exchange. The euro against the dollar against the yen. The euro showing a bit of strength, the dollar a touch of weakness. The euro 105.07, that currency pair positive 0.4%. The dollar was stronger against everything in G10 yesterday, with the exception of the Japanese yen. We can have a conversation about why. Dollar yen's 149.15, it breached 150 briefly. The why. There's a lot of suspicion that the Japanese authorities stepped in. They won't confirm or deny. Dollar yen, the chart speaks for itself, Bramo.
100%.
Doesn't it?
Confirm and deny is basically also confirming it.
The chart, I think, confirms something happened once we breached 150.
I think that would be true. I looked at two oddities, John. I looked at South African Rand, and it didn't get out to a 20, which is a round number. But what I really looked at was loonie. Canadian dollar is extremely well behaved, where it weakens from a 135 out to 1.42. It gets pointy and stochastic, where Trudeau dials 1-800-BIDEN and says, oops.
And no one picks up.
We're now at a 137 on loonie. Amy, it's USD, CAD is loonie. That's different from CAD USD, which is the tourist dollar. That's a long story. But the answer is we're not out to panic yet on some of these pairs.
You missed the joke there, Tom. Never mind. Under surveillance this morning, the underappreciated, unprecedented removal of Kevin McCarthy as House Speaker, raising fears of a government shutdown with the next deadline a little over a month away. McCarthy losing his post after Republican hardliners revolted against his decision to compromise with Democrats to avert a shutdown last weekend. The House expected to host Speaker elections next week, with the next shutdown deadline looming on November 17th. AMH just around the corner to weigh in on some of this. But the bond market moves, some might argue, are connected to what we're seeing down in Washington. Treasury Secretary Janet Yellen casting doubt on a higher for longer rates environment, saying this: people are trying to figure out exactly what it's going to take to keep inflation moving down. And the economic resilience that they see maybe suggests higher for longer, but we'll see. I think it's by no means a given. Lisa, when I heard this yesterday, I just thought, is that a wish, a prayer, a hope?
It's a put.
Or is that actually a reaction?
Well, it's not a put because she doesn't have that power to make it a put anymore. She has to keep borrowing. She maybe has to go over and plead over at the Fed to maybe buy a little bit more, but they're not going to listen unless they want to be accused of some sort of political interference. Right. There's a question here, though. At what point is there a real problem that Washington recognizes as they watch bond yields climb higher?
There's a feeling it might be right now. More data a little bit later going into payrolls, more key jobs data out this morning. ADP report, 8:15 Eastern time. The median estimate in our survey calling for payrolls to rise by 150,000. Comes on the heels of that JOLTS report. The JOLTS report, Tom, really, really strong, much higher than expected. Speaking to resilience in the labour market ahead of payrolls on Friday.
Some people suggesting there's some variability, some instability in JOLTS, and of course ADP we all know is a soap opera, but yeah, all of a sudden with everything circling here, including the speaker battle, the jobs report, you should tune in, folks. It's like the Super Bowl. We'll be there. You know, it's like, you know.
It's a Treasury sell-off looking for a reason. I'm with you. There's lots of flaws in the job openings data. The way they survey that data, responses to it, the fact that it's much easier to post a job opening. Maybe you should put more weight on the quits rate. The quits rate has come all the way back in.
Right.
But you put it together with the ISM manufacturing, we'll get services a little bit later, and the data's been better than anticipated.
Over the night, just quickly here, I did some analysis, and there's a new voting member at the Fed, Michael Barr. Michael Barr is a new voting member as of yesterday, and how we went from control to the beginning of a free fall. The guy in the policeman at the Fed, Michael Barr, is the one. He's a new voting member. He's going to call up Powell. He's going to say, "You got to be kidding me. Let me show you the evidence that we see out there."
Looking at the banks?
The banks, yeah, absolutely. Okay. They always, Bernanke 101, look at the banks. That's his research at Princeton years ago. When in doubt, how'd we screw it up in the 30s? We didn't look at the banks. Bernanke 101. Michael Barr's a voting member as of today. Gene Tenuzo could be a voting member someday, or a governor. Global head of fixed income at Columbia Threadneedle. He's surviving the wars. Gene, you know there's a point where it switches from yield analysis to price analysis. Are we there?
It does feel like we're there, Tom, certainly. You know, you're talking about it earlier. The sell-off we've seen in the long end of the yield curve is equal to the amount of work that the Fed's done at the front end of the curve all year. They've only raised interest rates by 1% through the course of this year, and maybe 25 basis points more. But the risk premium that we've put into the long end of the curve is really what has taken investors by surprise, I think, here, because it doesn't seem to be driven by the fundamental data. We would argue that the most important fundamental data of the last couple of weeks for the bond market is the fact that core PCE inflation, the Fed's preferred gauge, came in below expectations and is trending towards that 2% target. And yet we see this steepening, and I think that should give investors pause and think that really there is a fiscal risk premium coming back into the Treasury market.
Gene, have you changed your mind on that in the last couple of months?
Well, I think what we've been doing, John, is really trying to focus more on what we call the belly of the curve, or that 5-year point, where we think we've priced in more than a fair path for the Fed funds rate and more than a fair higher for longer situation. And you have yields basically from the 3-year point all the way out to the 30-year point sitting right around or just below 5%. And for that same yield, we'd rather put our money in the 5-year point, where you're more looking at what the Fed might do and less worried about that term premium or that risk premium, which we learned last year in the UK gilt crisis that can get away from you pretty quickly.
Gene, you think we've got the ingredients for that kind of outcome?
I really don't. I think it's a very different market. The depth in the U.S. Treasury market is significantly greater than what we see in gilts. But, it's that time of year, and it was just a year ago we were looking at what was going on in the UK, and that budget dynamic really did create scare across the market, and international investors drove yields higher quite rapidly. There are some similarities, but I do think the depth in the Treasury market is very different.
Gene, when we talk about the rest of the markets, aside from treasuries, you can look at stocks, which have been remarkably resilient in light of some of the recent moves. You can look at credit starting to maybe show a little concern, but largely holding in. Does this indicate to you that the rest of the risk complex can actually sustain yields that are rising at this pace to these levels, or do you think that there is yet to be a wake-up call that is coming?
No, I think the wake-up call is coming, Lisa, quite honestly, and we're starting to see that in liquidity of credit. It's starting to deteriorate, and spreads are widening, and bid offers are widening. So it's a little bit of that unfavorable dynamic we saw for a lot of 2022, and this week that started to reemerge. So I think that credit investors are getting nervous, and frankly, they realize that lags of monetary policy may be long or variable, but they do exist, and at the end of the day, companies and consumers are borrowing at much higher rates, and that's going to cause cracks throughout the system.
Are you seeing things actually break or force selling or anything that seems like a catalyst, or just a little bit more fear that causes a little bit more caution in investments?
I think it's more fear overall. Fundamentally, investment-grade companies, for example, are very cash-rich, and their cash flow profile is stronger than it was in 2019 before the pandemic. So I don't think there's anything that's going to disrupt that, from yields going up 1/4 to 0.5% in a short period of time. When we think about highly levered companies, and for example, look at the fact that CCC, those highly levered companies that have returned over 12% through the course of this year to date, well, they're going to be really susceptible to higher borrowing costs. And as we go forward, I think that rally is going to be hard to sustain.
Gene, let's go back to Minnesota finance just a few years ago. There's a chapter there, when it gets like this, look at the banks. You've got the advantage of Columbia Threadneedle that you're not representing a major bank directly in that, which is our advantage this morning. Are you stressed about the banks? Are they too big to fail, those regionals below them, and critically, the commercial real estate block below them?
I think most importantly, we feel really comfortable with the global systemically important banks, the sort of the big issuers here in the U.S. And we've actually been adding exposure since March through now to that complex. And we think that they're exceptionally cheap relative to their industrial peers. As you get down into the regionals and some of the tier below that do have more of that commercial real estate exposure, I think you do have to be a bit nervous. I think there's a degree of capital raising that's going on in that next tier of bank, but that's frankly, it's been orderly in terms of investors being able to lend that capital. But I don't think we should be so confident as to say we'll never revisit any of the volatility that we saw with SVB.
Gene, when you say you're adding, how are you doing that?
Yeah, I mean, we're adding in the new issue market and in the secondary. I think, looking at, the big, JP Morgan and Bank of America type, capital structures where, the capital profile has already been fortified post-financial crisis, unlike the super regionals that are having to add that capital now. So these are names that, over the last 6 months, we've been adding to portfolios, and, frankly, I think that they're a good alternative relative to potentially more cyclical corporate exposures.
Gene Tenuso. Gene, thank you for the insight. Gene Tenuso there of Columbia Threadneedle. On credit at the end, the banking stress we saw earlier this year, the financials really struggling, some of those big names, those bank stocks. KBW Bank Index cannot get off the mat. It's rolling over again towards the lows of spring after the failure of SVB. My big takeaway from that conversation, though, Bramo, that fiscal risk premium that you've got to start thinking about. Now, from people like Columbia Threadneedle, this is not something we talk about with Gene Tenusa. So Gene would say, yeah, we've talked about that for years. It's not a problem right now. Now it's starting to be something that really resonates with people in fixed income.
Which to me raises the specter of when does Washington start to watch the Treasury market more aggressively? I mean, seriously, because there's actual practical costs. Goldman Sachs did a survey. They actually increased, just from their survey in July, they increased their expectation for the federal deficit in the U.S., the fiscal deficit, $100 billion just simply by the move in yields by 2025.
Yeah.
So it gives you a sense of the real hard cash behind some of these moves.
I said it yesterday. How close are we to politicians just waking up in D.C. with a chart, the 10-year yield?
I mean,
after the moves we've seen.
I feel like they should be, because right now they should be.
Than John. They
right,
will.
but at
Congressman
some point,
French Hill is.
Yeah, and maybe others will start to join.
We'll see. Coming up very shortly on the financials on the banks, just a really sensible, sober voice for the financial stress earlier this year. Chris Marinac of Jenny Montgomery Scott on the financials. Chris is going to join us next. From New York, this is Bloomberg.